Good morning. This meeting will come to order. This is a public meeting of the Commodity Futures Trading Commission. I'd like to welcome members of the public, market participants, and members of the media, as well as those listening to this meeting on the phone and watching the webcast. We will consider today three Dodd-Frank reform rules that together bring transparency to the swaps market before a transaction takes place, so-called pre-trade transparency. These rules are, one, procedures to establish minimum block sizes for swaps, two, a process for a swap execution facility or a designated contract market to make a swap available to trade, and three, core principles and registration for swap execution facilities. In addition, we will consider today an interpretive guidance regarding Anti-Disruptive Trading Practices Authority. I'd like to thank Commissioners Summers, Chilton, O'Malley, and Weegan for their contributions to this rule writing process and all of the CFTC's hardworking and dedicated staff. I also want to express my condolences to Commissioner Chilton and all of his family for the loss of his stepfather last week, Ron, and I hope that Bart has been able to join us. I think he's closer to family right now, but I just want to check. Bart, are you on?
I am, Mr. Chairman, and thank you for the condolences, but I'm with you. Thank you.
Great. I see you're on the video link. Good. Today, the CFTC is voting on reforms that will make public transparency in the swaps market a reality. These reforms will make a trade execution requirement come to life. And though many of the 50 or more rules we have completed before today have brought transparency to this once opaque swaps market, today we take a significant step to open up this market. I want to underscore the significance of these three rules taken together. When light shines on a market, the economy and public benefit. These three rules, the block swap rule, the made available for trading rule, and the swap execution facility rule, taken together will provide the public with information trade by trade that it didn't have before. These three rules taken together will provide the public with the price and volume of every transaction in real time, and I mean in real time, as Congress says, as soon as technologically practicable. With these three rules taken together, they mean that anyone in the marketplace can compete and offer to buy or sell a swap and can communicate that to the rest of the public. And with these three rules today, no longer will this be a closed, dark market. The 2008 financial crisis, caused in part by the unregulated swaps market, led to 8 million Americans losing their jobs. It led to millions being forced out of their homes. And in the aftermath of the crisis, President Obama, along with the leaders of 20 other nations called the G20 leaders, committed during a summit in Pittsburgh in 2009, nearly 4 years ago, to bring needed transparency and oversight to the swaps marketplace. The leaders of the world's largest economies agreed, and I will quote, "All standardized OTC derivative contracts should be traded on exchanges or on electronic trading platforms where appropriate." It is that commitment of these G20 leaders that we come together to consider to finalize rules today. Congress fulfilled this commitment by including trade execution requirement in the Dodd-Frank Act. This means that swaps subject to mandatory clearing and made available to trade will move to transparent trading platforms. Market participants will benefit from the price competition that comes from trading platforms, where multiple participants have the ability to trade swaps by accepting bids and offers made by multiple participants. Congress also said that market participants must have impartial access to such platforms, so they would be open and competitive. In addition, Congress mandated that the public benefit from seeing the price and volume of swaps transactions smaller than a block size in real time, or as Congress said, as soon as technologically practicable after a trade is executed. So farmers, ranchers, producers, and commercial companies that want to hedge a risk by locking in a future price or rate will get the benefit of this competition and transparency through trading platforms called CEFs and designated contract markets. These transparent platforms will give everyone looking to compete in the marketplace the ability to see the prices of available bids and offers prior to making a decision on a transaction. And by the end of this year, a significant portion of the interest rate and credit derivative swaps market will likely be in full view in the marketplace before a transaction occurs. This is a very significant shift towards market transparency away from the status quo. Such common sense transparency has existed in the securities and futures markets for decades, and this transparency has lowered costs for investors, businesses, and consumers as it shifts information from the dealer community to the broader public. And it's that type of transparency that Congress mandated should be brought to this market, the swaps market. And as Congress made clear in the law, trading on CEFs and these designated contract markets will be required only when it's a financial institution transacting with another financial institution on swaps. End users will benefit from the access to the information on these platforms, but will not be required to use them. Further, companies will be able to continue relying on customized transactions, those not required to be cleared to meet their particular needs, as well as to enter into large block trades. And consistent with Congress's directive that multiple parties have the ability to trade with multiple parties on these trading platforms, these reforms require that market participants trade through an order book and provide the flexibility as well to seek requests for quotes. So to be registered as a CEF, these rules provide that a trading platform will be required to provide an order book to all its market participants. This alone is a very significant feature, as for the first time, the broad public will be able to gain access and compete in this market with the assurance that if they make a bid or they make an offer, it will be communicated to the rest of the market. This provision alone will significantly enhance transparency and competition in the market. CEFs also will have the flexibility to trading through requests for quotes. The rule provides that such requests would have to go out to a minimum of 3 unaffiliated market participants before a swap is executed, and this is just for those that are cleared and made available for trading and less than a block size. There will be an initial phase-in period with a minimum of 2 participants to smooth this transition. As long as the minimum functionality is met, an order book, a request for quotes model, and so forth, as detailed in the rule, and the CEF complies with these rules and the core principles, the CEF can conduct business through any means of interstate commerce. Yes, that includes a telephone, even the mail, the internet, computers. Thus, today's rule, as we consider it, is technology neutral. Under these transparency reforms, the trade execution requirement will be phased in for market participants, giving them time to comply. I think that today's reforms also fulfill the congressional mandate for the CFTC to set up appropriate minimum block sizes. Trades smaller than a block will be reported as soon as technologically practicable, enhancing transparency. And this will build upon the public reporting that began last December 31st. With today's trade execution reforms, all the major building blocks of swaps market reform will be complete: transparency, clearing, and swap dealer oversight. Looking forward, with over 90% of our rules behind us, if we move forward today on these 4 rules, it's a priority that the Commission finalizes guidance on cross-border application of swaps market reform, ensuring it appropriately covers the risk of U.S. affiliates operating offshore. The Commission is also pursuing an appeal of the District Court's adverse ruling with regard to position limits. I have also directed the staff to prepare a new proposed rule for the Commission's consideration to implement the speculative position limits required by Dodd-Frank. And with that, before we hear from the staff that will consider their suggestions today, I will recognize my other fellow commissioners for their opening statements. Commissioner Summers.
Good morning. Thank you, Mr. Chairman. This is a momentous day for the Commission and for market participants because we are finalizing the long-awaited trade execution rules. and also for me personally, because this is likely the last time I will participate in an open meeting to consider Dodd-Frank rules. It has been an incredible learning experience for me over the past 3 years, and although I think the Commission would have reached different conclusions on many of the foundational rules if we had been consulted earlier in the process, I really appreciate all the time that the staff has dedicated to this very challenging and oftentimes overwhelming task that we have been given. Today, we are considering rules on swap execution facilities, minimum block sizes for swaps, the process to make a swap available to trade under 2H8 of the Commodity Exchange Act, and guidance on how we will interpret the disruptive trade practices authority contained in 4CA5. That is a lot of ground to cover, so I will make my comments brief. With respect to setting block sizes, I have acknowledged in the past the difficulty of establishing the appropriate minimum thresholds. The goal is to promote transparency as much as possible without reducing liquidity in various markets. The Commission cannot achieve this goal without appropriate data. When we proposed the block rules, I applauded the team's effort to analyze the data that was available at that time in interest rates and credit default asset classes, but noted that the team had only access to 3 months' worth of data from 2010. Regrettably, even though reporting has begun in the swaps markets, we are relying on the same stale data to support the final rule. We are also finalizing the 67% notional amount formula, which, as I observed at the proposal stage, would allow for only the largest 6% of all interest rate and credit default swaps to be executed as blocks, and we are applying the 67% formula across all asset classes. This approach, in my view, ignores Congress's mandate that we take into account the impact of public disclosure on liquidity when setting block sizes. These are not one-size-fits-all markets, and we should not be adopting a one-size-fits-all approach. I appreciate that we will initially use a 50% notional amount formula in order to phase in the impact of the minimum block sizes, but the rules provide for an automatic adjustment to the 67% formula after 1 year, no matter what the data shows at that time. Minimum block sizes should be driven by the most current objective data available, not an automatic across-the-board formula based on stale data. My objections to the made available for trading rules also remain the same as when we proposed these rules. A few minor revisions have been incorporated into the final rules, but as proposed, the final rules provide that designated contract markets and CEFs, rather than the Commission, will make the determination of when a swap has been made available to trade by considering, a list of factors that fail to contain any objective standards. Although we claim we will review the certifications or requests for approval to determine whether a swap is suitable for the mandatory execution requirements, in fact, our hands are tied. Unless a MAT determination is inconsistent with the Act or our regulations, we must approve it or deem it approved. But because neither the Act nor the final rules contain any objective requirements that a swap must meet for a MAT determination to be valid, it is difficult to envision how we could ever find such a determination to be inconsistent with the Act or regulation. This approach allows a CEF or DCM to bind the entire marketplace to a trade execution requirement as long as the swap must be cleared, even if liquidity is lacking. This is overly broad, potentially inconsistent with foreign regulations, and just plain bad policy. I suppose we are crossing our fingers and hoping that CEFs and DCMs will be reasonable when they make their MAT submissions and will submit only highly liquid products that are truly suitable for mandatory execution requirements. But I would not count on that. My comments on the disruptive trading practices guidance relate to my hope that the guidance has clarified how we intend to apply this authority in our enforcement actions. Guidance should be helpful and not create more questions than it answers. While we have made some improvements in the final guidance, I am hopeful that as time passes, the Commission may be able to provide more clarity to help the market in certain areas. With regard to the CEF rulemaking, although a lot of noise has been made in the press about the request for quote number, I have a number of other concerns with the CEF final rules. As with many of our rules, we have gone beyond congressional intent by imposing requirements not called for by the statute. The order book and RFQ requirements, to name just a few. Nothing in the statute mandates these minimum trade functionalities. We made them up. This puts us out of sync with the SEC and, I suspect, with foreign regulators when they finalize their rules. I'm glad that we have lowered the RFQ requirement from 5 to 2 initially, but as with the block rules, the CEF final rules provide for an automatic bump to 3 after 1 year for all contracts that must be cleared, no matter what the data shows or how illiquid these contracts may be. We should base any decision to increase the RFQ requirements on objective data. There is no reason not to. We have taken a very narrow interpretation of what the statute allows and incorporated it into these final rules. I believe we will regret this restrictive approach because it may cause the U.S. to lose this business to foreign jurisdictions that do not stifle illiquid contracts in this way. I also have questions about why we have refused to contemplate a framework that would allow for exempt CEFs and exempt DCOs, which are clearly included in the statute. Although both concepts are mentioned in the preamble, we failed to give any commitment to develop a process for determining this exempt status. I look forward to all of the staff presentations and to asking some additional questions, but would like to finally say that I want to thank especially my staff that I have been privileged to work with over the last 6 years, as well as the entire Commission staff. Truly, I want to thank you for everything that you've done for me and wish all of my colleagues my gratitude for their kindness and respect, and best wishes as you continue your public service. Thank you all.
I want to pause for a moment and thank Commissioner Summers for your service and for your friendship. I know that we sometimes come at these rules and the day-to-day life with a little bit different perspective. We've agreed far more than we haven't, and any time that we've disagreed, we've always, I think, disagreed agreeably. And you have been a marvelous colleague and a remarkable, dedicated public servant, and I thank you. For 4 years, we've served together. Commissioner Chilton, I think, on the video somewhere.
Yeah, I'm here. Thank you, Mr. Chairman, and thank you, Commissioner Summers, for all your service. And we came at the same time, and I very much enjoyed working with you, including on some work we did on the CEF rule, which, quite frankly, I think might have been a better compromise than we're dealing with today. But thank you for trying to work to get some of these things done. And whenever you had a suggestion, it was always very thoughtful, and a lot of times made the rules better. Even if once in a while you didn't vote for it, you made the rules better, and that's very admirable. So we're going to miss you. So I've never been a more sort of reluctant and reticent regulator than today on these rules. I think we need to do them. They've been out there for a long, long time, too long. But I'm just not super plussed by what we have. I'm not saying they're bad, and I'm not saying that the staff didn't work hard, but I just wish we had reached a different compromise. Churchill had this great quote about how the English always blur the lines on everything. And I think we really blurred the lines on some of these proposals, in particular on CEF. And I think we could have had more transparency and still been totally consistent with the law. I think we've done just the bare minimum of what those who voted for Dodd-Frank envisioned. At the same time, I think those who voted for Dodd-Frank and the president who fought for it, I think they'd also say, well, look, there's two things that have been going on while we've been sort of messing around trying to figure this out. One is that we've seen this futurization going on. So we've seen, swaps getting moved to exchanges, some of the standardized swaps, and that brings a regulatory light to those swaps, but it also is a disservice to the would-be SEFs. By default, we've been creating winners and losers, and that's not appropriate. And the second reason that we really have to act is that something that the chairman spoke about is these dark markets, the swaps markets, they were part and parcel to the economic collapse. So if we don't do anything, they're totally unregulated, and the futurization will continue. So as I said, I'm sort of a really reluctant and reticent regulator today, but I think we need to move forward. I do have some questions, and I do want to get some clarification on a few things as we go through. But at the end of the day, Dodd-Frank was about getting rules and regulations for dark markets in place almost above all else. And I hope that we end up doing that. Thank you.
Thank you, Commissioner Chilton. Commissioner Amalia.
Well, I guess I didn't appreciate the fact that this could be your last meeting. And I didn't write a speech for that. So I cannot sing a song. But what I propose to do, since we only have the microphones, but I know everybody in the audience and the press at the staff table all appreciate your efforts. So I think it would be appropriate we all stand and recognize Jill for her efforts. Truly a remarkable career in public service, private sector, was very helpful to me when I arrived here and helping me navigate the building, understand the process, et cetera. So I'm grateful for all your advice and counsel and recommendations. So a great run. So we look forward to seeing what you're going to do next. Mr. Chairman, thank you for calling this meeting to finalize a critical suite of rules regarding swap execution. The adoption of these rules will bring the Commission in compliance with 3 of the 4 principles agreed to by the G20 nations who finalized the Pittsburgh communique back in September 25th, 2009. The 3 principles that have been achieved so far are the reporting of all trades to a trade repository, requiring that, quote, all standard OTC derivatives be traded on exchange or electronic platform where appropriate, and 3, clearing through central counterparties. Notably, the data rules were one of the first set of rules implemented by the Commission. While these rules are not without flaws, data is the foundational element of which our regulatory oversight begins because it shines a light on the true makeup of the market, including the trading and risk relationships of this previously opaque market. From this point forward, the excuse of we don't have the data simply does not hold water. We have 3 SDRs all collecting information regarding real-time, historic, and regulatory data. The big question in my mind is, will we use the data to support decisions by this Commission, or will we selectively ignore the facts when it doesn't suit our concerns and our outcomes? Of course, this achievement wouldn't be possible without the hard work and dedication of the staff who have done and labored endlessly to put together the thousands of pages we're considering here today. Everybody at the table, everybody who's coming to the table, thank you very much for your patience and time and effort to help explain the rules to me, work through the comment letters, et cetera. It is, I greatly appreciate all the work you've done and all the forces that have been upon you. I would also like to recognize Bella Rosenberg, who had the responsibility for both the CEF and made available for trade rules prior to coming to my office. She has done a marvelous job in the service to this commission as well. Today, the big rule everybody is waiting for is the swap execution facility final rule. It has been over 2 years since the draft rule was first voted on back in January 2011. Since that date, the product has evolved, but it has always remained a little more prescriptive and limiting than what was required by the statute. Having said that, I'm excited about the opportunities CEFs will provide in bringing transparency to the swap market, and I support a flexible framework to ensure that all participants have the opportunity and, frankly, don't have the excuse not to trade on a CEF. Now let me turn to some of the particulars of the CEF rule, and I've argued strongly and encouraged the Commission to adopt a temporary registration process for CEFs that did not replicate the temporary registration process for the swap data repositories. In that respect, I believe we have succeeded. I believe a streamlined temporary registration process will not disadvantage CEF applicants that are received later in the queue or as the big bulge of new CEF applications arrive on our doorstep in the coming days. More importantly, I am concerned with the process the Commission is using to shift the number of trades on an RFQ from 2 to 3 participants. It is incredible to me that the Commission rushed to implement the data rules to ensure that it can make informed decisions, and yet has chosen to pick an unsubstantiated number without utilizing the available data. A transparent rulemaking process should utilize available data to make fact-based decisions. However, both the CEF rule and the swap block rule suffer from a willful refusal to utilize available and useful data. Now, as Commissioner Summers noted in her remarks, it still remains to be seen how these rules will be coordinated internationally, and that is an important feature, and I want to make sure that we are nimble enough to respond to that competitive imbalance, and we have create rules that will keep liquidity here in this country. With regard to the swap block final rule, my frustration lies more in the process than in the outcome. I agree with the premise, the goals of promoting pre-trade price transparency and trading on a CEF. However, the foundation of any block size, whether it is a swap or a future, should be based on good data. Again, the Commission is forced to develop a rule without the benefit of extensive data in the financial products and no swap data in the case of foreign exchange and commodities. In fact, the Commission's meager data used to inform its decision on financial products comes from just 3 months' worth of data back in 2010. Like the CEF rule, the Commission has not availed itself to available data and decided against making an informed decision regarding the block rules to automatically move to 67% of the notional value for each swap category after the initial period. Therefore, I am prepared to offer an amendment to this rule to require the Commission set block rules based on the study using actual trade data. And I've circulated that at the table here among my colleagues and staff. Now let me turn to the MAT determination. I recognize that the challenge the Commission is facing in interpreting the made available for trade provision. Unfortunately, the Commission did not provide the Congress did not provide the Commission with any guidance as to how and under what condition the trade execution mandate must be considered or triggered. The rule, however, provides illusory comfort that the Commission will have the legal authority to review and, if necessary, challenge a mandatory trading determination made by a CEF or DCM. In fact, the only authority that the Commission has is to rubber stamp a CEF or DCM's initial determination. Finally, the process for removing a made available for trade determination lacks any logical or legal basis and is the exact opposite of what is required to make the initial made available for trade determination. With regard to the disruptive trade practices, it has been a long process since the initial advance notice of proposed rulemaking back in 2010, and the proposed guidance was published in 2011 in February, and finally now we are voting on the final guidance today. The team has made significant progress in giving meaning to the Commodity Exchange Act, Section 4CA5, which prohibits disruptive trading practices. While I applaud their work in this regard, I do have some concerns that the guidance provided with respect to interpretation of disruptive trading and spoofing, while the guidance we provide says, quote, it's always a facts and circumstances test, end quote, then we really aren't providing guidance. So I have some questions that hopefully will further illuminate the guidance and how we're going to proceed on this in order to give the market some certainty on where we're going. I do want to close again by thanking Commissioner Summers and certainly the staff for all their work in putting all these pages of work together and these rules. They have increasingly gotten better as time has gone on and the input has been received. I look forward to finalizing these important rules so that the market can move forward with a greater certainty surrounding the development of the swaps market. So thank you.
Thank you, Commissioner Amalia. Commissioner Wiegand.
Thanks, Mr. Chairman. Since joining the Commission, I've had the good fortune and pleasure of meeting a lot of good friends, but no one has been a better friend to me since I've arrived than Commissioner Summers. And no one has provided more useful, interesting, insightful counsel and just overall very helpful insights about these markets and the work of the Commission than you have, Commissioner Summers. So I know our friendship will continue beyond your tenure here at the Commission, and I look forward to remaining friends and also seeking your counsel even after you leave. So thank you again for your service. Today's releases will fundamentally restructure the over-the-counter markets for swap trading and increase pre-trade transparency and participation for many that were previously unable to access or compete for liquidity in the OTC marketplace. This is a landmark achievement for the Commission. I believe that taken as a whole, the Commission has struck an acceptable balance in these final rules. I'm certainly confident that the new execution framework recommended by the professional staff in consultation with public interest groups, the industry, and the regulatory community over the course of the past 2 years or so represents a fundamental shift away from the OTC model as it existed only a few years ago. The benefits of this shift are many. For example, mini swaps will for the first time trade on regulated platforms and benefit from market-wide pre-trade transparency, which should improve pricing for the buy side, commercial end users, and other participants that use these markets to manage risk. Additionally, CEFs, as registered entities, will be required to establish and enforce comprehensive compliance and surveillance programs that simply do not exist in the swap markets today. Another potentially significant benefit not as often discussed is the improved ability for clearinghouses and their members to manage risk during times of market stress, effectuated by liquidity formation on CEFs should these platforms function as envisioned by these rules. The final rules also will facilitate compliance with Dodd-Frank's other derivatives reforms, especially real-time reporting, clearing, and straight-through processing. In this respect, the execution rules complement the Commission's other efforts to streamline participation in the markets by doing away with the need to negotiate bilateral credit and other provisions in order to access liquidity. This not only benefits the end users that the markets are intended to serve, but also new entrants that intend to compete for liquidity and now will be able to access the markets on impartial terms. In essence, the final execution rules support a transparent, risk-reducing swap market structure under the oversight of the Commission. Like all of the Commission's rules, today's releases require the Commission to make a number of policy judgments that necessarily involve trade-offs. And in making those judgments, the Commission faces the challenge of creating a new market structure on paper while being informed only by what we know or think we know about the swap markets today. The Commission therefore must remain open to reassessing the policy judgments in these final rules as the markets evolve, as the Commission has provided new information, and as the Commission benefits from its experience overseeing the new CEF market structure. In short, the Commission must remain open to course correction where necessary and ensure that the swap regulatory regime keeps pace with the markets that it governs. One difficult and widely reported policy judgment concerns the required trading protocols for executing certain swaps subject to the trade execution mandate. A significant number of commenters cautioned the Commission against imposing specific trading protocols on the marketplace. Comment letters suggested, for example, that such rules might have the unintended effect of increasing hedging costs for liquidity providers, thereby adversely affecting pricing for the firms that depend on these providers to assume risk. Other participants have expressed concerns that relatively illiquid swap markets, like off-the-run credit, might be dislocated if the Commission tries to force immediate changes to the currently used means of execution. These concerns and others have contributed to a constructive dialogue both inside and outside of the Commission. Having considered the panoply of execution issues and policy trade-offs at length, I am confident that the final execution rules before us today contain appropriately flexible trading protocols. Furthermore, it is also my belief and understanding that if questions of interpretation arise from market participants concerning permissible trading protocols, the Commission staff should err on the side of flexibility when providing interpretive guidance. Incidentally, flexible trading protocols is not code for status quo, as some might suggest. It is not code for pro-dealer trading protocols, nor is it code for pro-buy-side or pro-retirees, pensioners, endowment beneficiaries, and end-user trading protocols, although I do believe it is these constituencies who stand to benefit the most from this flexibility. Instead, what flexible trading protocols really means is consistency with congressional intent as it relates to swap trade execution under Dodd-Frank, which on its own was destined to bring dramatic change to the OTC swap markets. Again, the changes are many. Under Dodd-Frank and our implementing rules before us, every CEF will be required to have an order book, another transparency-enhancing change to the existing market structure. But a number of important safeguards built into our rules also ensure that participants continue to have access to competitive, timely, and representative prices, as well as liquidity, when order book trading may be somewhat premature. One such safeguard, of course, is the block trading rule, which sets the thresholds above which certain swaps can be executed through even more flexible trading protocols. In my view, the long-awaited block rule is consistent with Congress's intent to drive a significant portion of OTC swap activity into a multilateral trading environment. And as a complement to the CEF regime, the block rule will for the first time usher in real-time post-trade transparency throughout the swap markets. This rule, though perhaps not ideal in several respects, is undoubtedly improved from the uniform social size approach first proposed in the real-time reporting rule in 2010. Public comment has been essential in this regard. Many commenters raise concerns about the methodology for reaching the block trading thresholds, the data set upon which the staff has applied that methodology, and definitional judgments that impact transaction distributions and therefore outcomes under the final rule. The Commission will need to keep a close eye on these matters once the rule becomes effective. As the markets evolve and the Commission receives new data with which to analyze and set the block thresholds, the Commission has a responsibility to revisit our approach and consider whether this rule has in fact landed in the right place. The final rule's approach is admittedly blunt, but the Commission has attempted to balance as best it could potentially conflicting objectives. As a final note, I have been especially concerned about supporting a competitive landscape for derivatives execution. Recent actions and comments by some have suggested that certain of the Commission's rules unfairly or inappropriately favor futures execution. Again, the intent of these execution rules before us today is not to do away with flexibility, but rather to protect it. What should be clear in the Commission's rules is that participants will have clear choices. Choices concerning margin treatment, modes of execution, clearing venues, and in some cases counterparties. If participants weigh carefully the available choices and choose a particular execution venue based upon their own economic interests, the Commission should not second-guess that decision and substitute its own. In the end, it is the participants, not the Commission and its staff, who will determine the types of risks that firms should retain or lay off in the markets and the means for doing so. The Commission has strived to promulgate these rules in a manner that will avoid putting its thumb on the scale for any particular marketplace. Thank you again to the staff for all of your hard work on all of these rules today, and I look forward to discussing a few questions a little bit later. Thanks.
Thank you, Commissioner Weegan, and thank you again to all of my fellow commissioners for all their input on these rules. I think they've tremendously benefited from each of the input, and though we might not go over the line unanimous today, as I sense from the opening statements, I think that the rules have each benefited from the input And I want to thank, particularly, if I might, Commissioner Weegan. It seems you and I have been getting some press recently, but I think this is a far better rule, and I agree with your statement that these fulfill the congressional mandate and really do deliver to the American public in a balanced way with transparency. But with that, I think that I'm going to invite the first panel. The staff will make presentations concerning their recommendations of the final rules implementing the Dodd-Frank Act, as well as the interpretive statement. After each presentation, the floor will be open for questions and comments from each of the commissioners. Following these discussions, the commission may take votes on the recommendations as presented. All final votes conducted in this public meeting shall be recorded votes, and the results will be included in the relevant Federal Register releases. I think I'm supposed to ask for unanimous consent to allow staff to make technical changes.
So moved.
Absent second. It being unanimously consented. At this point, I also ask unanimous consent to allow. Oh no, I did that one. All right. So presentation number one. The swaps block rule or procedures to establish appropriate minimum block sizes. And I want to invite Rick Schiltz, the head of the Division of Market Oversight, George Pullen, who's from the Division of Market Oversight, Nan Nguyen, you'll be helping on this one as well, Nan? All right. Nan Nguyen from the Division of Market Oversight. And then from the Office of General Counsel, John Dunphy, who is now, I guess, our team lead on this. And then Essen Omar from our Chief Economist's Office. So I turn it over to the team. I guess that's to you, John.
Thank you, Mr. Chairman and Commissioners, for the opportunity to present this final rulemaking today. I would like to thank each of the members, past and present, of the Swaps Block Rule Team for their hard work and contributions to this final rule, which we present to you today for your consideration and vote. Staff is recommending for the Commission's consideration final rules establishing appropriate minimum block sizes for large notional off-facility swaps and block trades, as well as measures to protect the identities of parties to swap transactions. Section 727 of the Dodd-Frank Act created Section 2A.13 of the Commodity Exchange Act. Section 2A.13 requires that the Commission issue rules regarding the real-time public reporting of swap transaction and pricing data. The section specifically requires the Commission to do three things that we do in this final rule. First, specify the criteria for determining what constitutes a large notional swap transaction or block trade. Second, to ensure that the public dissemination of swap data does not reveal the identities or business transactions of swap counterparties. And third, the Commission must take into account whether public disclosure will materially reduce market liquidity. In December of 2011, the Commission adopted the real-time reporting requirements in new Part 43 of its regulations. In that final rulemaking, the Commission adopted several provisions relevant to today's final rule. The real-time final rule established 5 asset classes for swaps: interest rates, credit default, foreign exchange, equity, and other commodity. The real-time reporting final rule also established a series of time delays for the public dissemination of swap data. Because the Commission did not establish a block size methodology at the time of the real-time rule provided that all swap trades would be subject to the block time delay specified in the real-time rule, pending a Commission rule establishing minimum block sizes. In February of 2012, the Commission issued a further proposal regarding block sizes and anonymity protections. In issuing that proposal, the Commission was informed by many comments received regarding the initial real-time rule regarding blocks. Today, staff recommends for the Commission's consideration final rules springing from that proposal that establish minimum block sizes for swaps and anonymity protections for parties to swap transactions. Today's final rule benefits from numerous comments from those who are potentially impacted by the rule. The rule also benefits from the fact that staff was able to collect and review relevant data for two asset classes: interest rate swaps and credit default swaps. Based upon this data and comments received, the final rule establishes, first, detailed criteria for grouping swaps based upon the primary economic indicators within each asset class. Second, tailored and measured methodologies for determining minimum block levels in a two-phased approach. And third, additional measures to protect anonymity related to the public dissemination of swap data. I will briefly explain the major components of the block trade rule as well as the anonymity measures. With respect to blocks, the final rule breaks down the 5 asset classes that I mentioned a moment ago, established by the real-time reporting final rule, and breaks them down into smaller swap categories. Swaps within each asset class are generally grouped based on common risk and liquidity profiles. For swaps in the interest rate asset class, the final rule establishes 27 swap categories based on 9 tenor band groups and 3 currency groups. For swaps in the credit asset class, the final rule establishes 18 swap categories based on 6 tenor band groups and 3 conventional spread groups. For the FX asset class, the final rule establishes approximately 85 swap categories based on unique currency combinations. For the other commodity asset class, the final rule establishes approximately 120 swap categories based on groupings of economically related swaps and groupings of swaps sharing a common product type. In establishing methodologies for determining appropriate minimum block sizes, staff sought to balance the goals of transparency and protecting market liquidity. The final rule establishes that the Commission will prescribe appropriate minimum block sizes for the swap categories within each asset class through a 2-period phased-in approach. The first phase, called the initial period, includes different methodologies based on the availability of data. For the initial period, the final rule sets block sizes in the interest rate and credit default asset classes based upon data obtained and analyzed by the Commission staff. Sizes will be applied to each swap category within these asset classes based on a 50% notional amount calculation methodology. That methodology determines block sizes by looking at the net notional distribution of swaps and setting the block size at the 1/2 mark within that distribution. Staff believes that the notional determination methodology is a better measure of risk than other alternatives, such as setting the block size so the specific number of trades could be done as blocks. This notional amount methodology focuses upon the amount of risk in a given swap category. For example, a 2-year cross-currency U.S. dollar-euro interest rate swap will have a block size of $460 million. For the FX and other commodity asset classes during the initial period, the final rule sets block sizes based upon DCM block sizes set for economically related futures contracts. Staff believes that DCM set block sizes for economically related futures contracts are a good comparative measure for setting swaps blocks. For the initial period, the final rule sets out in Appendix F the specific minimum block sizes by swap category based on these methodologies. The initial period will last until SDRs have collected 1 year of data for each asset class. After the initial period, the final rule states that the Commission will establish post-initial minimum block sizes for each swap category in the interest rate, credit default, FX, and other commodity asset classes based off data collected by SDRs using a 67% notional amount calculation. The rules also provide that the Commission will update minimum block sizes no less than once each year using the same 67% notional amount calculation. Post-initial block sizes will be published on the Commission's website and will become effective on the first day of the second month after publication. For equity swaps, under the final rule, these swaps will not be eligible for block treatment, and thus these swaps will be publicly disseminated in real time in both the initial and post-initial periods. This is because of the existence of a highly liquid underlying cash market, which is where price discovery occurs, the absence of time delays for reporting blocks in that market, and the relative size of the equity swaps market relative to futures, options, and cash index markets. The rule also establishes a series of special rules to deal with complex issues, such as how to determine block sizes for swaps with optionality, how to determine block sizes for swaps in other currencies, and how to address a situation in which a member state is removed from the Eurozone. The rule also prohibits aggregation of orders to satisfy block requirements. The rule establishes a process for market participants to elect to treat their swaps as blocks, and how notice of that election will be sent to a CEF or DCM if such swap is traded pursuant to the rules of a CEF or DCM, or if it's traded bilaterally, how reporting parties would provide notice to an SDR. Also, the rule allows the Division of Market Oversight to undertake all responsibilities related to the establishment of block sizes. As I mentioned earlier, this final rule addresses more than just block trades. It also includes measures to protect anonymity related to swap data. First, the rule amends Part 43 of the Commission's regulations to establish a permanent system establishing cap sizes for masking notional amounts of swap transactions reported to the public. Cap sizes will be set using a 75% notional amount calculation, similar to the methodology used for setting block sizes. Secondly, in regard to anonymity, the rule establishes that certain commodity swaps will be subject to real-time reporting with masking of the specific geographic delivery or pricing point detail related to these swaps. This concludes my prepared remarks regarding the block trade final rule. My colleagues and I would be happy to answer any questions you may have regarding the rule.
The chair will now entertain a motion to accept the staff recommendation concerning the final rule.
So moved.
Second.
Being motion made and seconded, then it's open for discussion and questions. I don't have any questions for John and the team, but I do support the final block rule, which is, I think, critical to promoting transparency in these markets. I think that with this rule, the public will benefit from seeing the price and volume on transactions, post-transaction, as soon as technologically practicable. Those are words that Congress put in the statute, and we will fulfill that mandate. Initially for approximately 50% of the market, and subsequent to the post-initial period to 67% of the market. So half of the market wouldn't tighten up to that period, or after the post-initial, a third of the market will not. But I think that it's critical for the non-blocks to have that, which Congress wanted, is real-time reporting. And it also, in conjunction with the swap execution facility rules that we'll consider later today, brings to life the trade execution mandate, and together is very critical. I do think the Commission has benefited from significant public input on these rules. We first proposed a block rule, as Commissioner Wiegand noted, and it had a different methodology called social size, I think, if I remember the words we used. And we got significant public input suggesting that we should move to a different methodology. And in fact, many of the commenters then suggested moving to something similar to what we have in front of us today. We took those comments to heart, and we decided to re-propose a block rule. And that re-proposal benefited from that first set of comments. And it also laid out a significant number of alternative methodologies, but the bulk of the commenters came back and said this methodology, percentage-based as it is, to be addressed on an annual basis with an initial period and a post-initial was an appropriate approach. There were comments that some thought we should be higher, some thought we should be lower, and there was significant commenters supporting ultimately going to 67%. So I think the Commission has already noted in this context that it has had substantial public input, but also we have delayed the movement up to 67% until there's 1 year of data, which is already coming into the swap data repositories, as has been noted. I think the 67% formula has been well noticed. It's been subject to public comment. and there's ample support in the public record for adopting that, but having that methodology apply to data that we later collect. So I support the rule. I'm going to turn it to Commissioner Summers for her questions.
Thank you, Mr. Chairman. I just have a couple of questions about the methodology and, as I said in my opening statement, this has been a challenge, I realize, and the Commission has struggled with block sizes for many years and trying to determine an appropriate methodology. So just to kind of walk through this specific methodology and the 67%, that when you use this formula based on the notional value in a market, then it gives you a percentage to which would set the threshold for block sizes. So do you, when you're looking at whether 67% is an appropriate number and specifically applying it gets you, I think it was 6% of the interest rate market based on the data that we're using would be your block threshold. Do you decide that 6% is what we're looking for, therefore 67% is right? Or do you know that 67% is right and it doesn't really matter where the threshold, because based on the notional value of that class, what if you end up getting 20% of the market as a block? Do you then decide that 67% may not be the right number? I mean, is that going to be flexible for us, or no matter what, 67% is the number? Just sort of walk through with me how we decided that those are the appropriate numbers.
Okay, and just to clarify for a moment, so the 67% notional amount calculation is going to give you a block level in notional. And so based upon that level, or in notional terms, 67% of the market will not be blocks, 33% of the market will be blocks. The numbers that you're referring to are in regard to number of transactions, right? So on the data that we have for interest rates and credit default swaps, applying the 67% notional number, 94% of the transactions for the time period that we looked at would not be blocks. In crafting the 67% and in initially proposing the 67%, we were guided by the very goals that you were mentioning in your opening statement, which were to bring real-time transparency to a significant amount of the market, but at the same time to protect liquidity by saying that very large transactions could be done with a time delay. And we thought that the 67% test, which, as you say, did cover 94% ultimately being not blocks, that did those two things. Now, as the chairman was pointing out earlier, in terms of the comment process, we've gotten a lot of comments in regard to the 67%. So the way that we went about this enabled us to tell people we're going to do 67. Here are the numbers, not just this is the methodology for commenters to comment on, but also here are the results of that methodology. And here's what the exact block number is going to be in the initial period, at least based on these numbers. And so we sort of have a dual benefit in terms of the comments, both for the methodology and the result. And so based on the comments that we got, we think that 67% is still the right notional methodology.
Have we ran this methodology using even a subset of the current data that we're collecting to know that we may get the same sort of result? At least some sort of consistent result with current data?
George?
I think the best way to answer that is to look at the way 67% works out in the current data set that we've used, which is the ODSG voluntary data set of 2010 that you've mentioned that we got in 2011. When you look at that data set, the numbers, as you mentioned, come around 90-95% end up not being block. But because of a notional methodology, if you have, regardless of the data set, whether it's the one in our current SDR or the one in the SDR a year from now, if you had completely uniform distribution of size, and that would mean that everybody within one of our 250 plus swap categories all traded a size of 1 million, for example, what ends up happening is you could have up to, with complete uniformity, 33% being blocks. So in the data set that we had, of course, we ran to the situation and the numbers that we provided to you where you have approximately 5% being blocks, but you could have in the future an example where 33%. And again, even in the future, it's always based on a historical look back. It's the method of any statistical sample. It's always going to be a historical look back.
Okay. My additional concern with this approach is just the inconsistency that could be could arrive between DCMs and CEFs, because we're setting the block sizes for CEFs, DCMs set their own block sizes, and if there are economically equivalent contracts, at least some may say that DCMs have an advantage. Do we intend to take a second look at how we approach block sizes for DCMs? Or, I don't know, Rick, you may want to.
But if I could just clarify real quickly, this rule is a swaps block rule, so applies to swaps whether they're on a CEF, a DCM, or off facility. So in regard to swaps, there's not a distinction in terms of where the block levels.
I'm sorry, I should have made that distinction. I meant futures that are traded on a DCM that could be economically equivalent.
Okay.
And I think a couple points. One is, excuse me, is that I think some of these issues have been mostly raised in the connection with other commodities, and as this rule adopts in the initial period, is that it's looking to the DCM's block sizes for equivalence. So they're, in that sense, that's being addressed.
You may want to pull your mic closer, and John, if you turn yours off.
Okay. And the second point is, yes, the staff is an interdivisional team that is looking at issues related to the setting of block sizes on DCMs and is contemplating some sort of potential commission action or regulations, rulemaking that would address issues related to the setting of block sizes on DCMs, and particularly with respect to the so-called futurization of swaps that happened last year, where a lot of them were listed, especially in the energy areas, listed as futures. So it is something that we're looking at.
In a year from now, when those block sizes for CEFs are when they're no longer using the DCM block sizes for CEFs in the other asset classes, will we go out for additional public comment on those asset classes to make sure that everyone's aware of how this is going to work for those additional asset classes?
Well, as you know, the rules provide that there would be an automatic adjustment in the post-initial period, but depending on what the commission does with respect to future rulemakings in the DCM block size calculations or whatever, it's hard to, I can't say what would happen a year from now, but potentially there'd be reconsideration of that.
Thank you.
Thank you, Commissioner Summers. Commissioner Chilton.
I just have one question. I'm curious why the block and the trading mandate rules don't seem to go effective at the same time. If the block rule goes into effect prior to a trading mandate, and a trader wants to trade a smaller than the block size trade with one dealer, which they could do, it seems like they could only do it off CEF, away from the CEF, and that would seem to punish the CEF, and it would also deny the regulator, us, with an audit trail. Can you respond to that?
Well, and it may be good that I have Non up here for this question also. But just in regard to the swaps block piece of that question, I believe that both the swaps block rule and the CEF rule have the same effective date. And so, and I understand you're sort of saying when does the trading mandate go effective? But it is at least theoretically possible, I think, that the trade that you're describing actually could occur on a CEF after the block rule goes effective. So that's sort of answer one in regard to the swaps block rule. But also, I don't think that the swaps block rule itself, in terms of how its effective date matches up with other effective dates, really makes a difference in terms of what one's choices would be in transacting that swap. So if one could do it off facility today and then the block rule goes effective, that's still how they would be able to do it. And so I don't think there's sort of an execution difference that's based on the block rule for that trade. And I also don't think there's really an audit trail difference. There may be a difference in terms of when the public and when the commission would see the information in terms of how quickly, but ultimately I think the audit trail would be the same, that the transaction would still be subject to reporting.
Okay. Thank you for that. Appreciate it.
Thank you, Commissioner Chilton. Commissioner Amalia.
Thank you, Mr. Chairman. I think it's important to make sure I get consideration on this motion. I make a motion to adopt my amendment to the swap block rule at this point.
I have to check whether I'm supposed to let people ask questions first, but
we can adopt it. We can
What's
make
that?
the motion now, and then we can get back to
Second.
questions.
Is there a second? Now
Thank
there's
you.
a second. Yeah.
All right. Thank you, Mr. Chairman. Thank you, Commissioner Summers. Reading the preamble, and I think the chairman mentioned it and Commissioner Weegen mentioned it, that there was support for the 67%. And in reading the document on page 79, it says 28 commenters provided general comments on the post-initial, the 67%. Of that, 12 supported 67%, 14 opposed, 2 kind of said we don't have enough information, largely based on the data. A lot of the people who opposed the number were also concerned that they did not have enough information based on the data that was in the rule when it was drafted in the proposal stage to make a comment as to whether that's accurate. And Commissioner Summers and I have both raised the concern about the data. Not much we could do about it beforehand when we were developing this rule. I appreciate that fact. But since January, we've been receiving data. And have you run the calculations based on that data, and what does that data tell us so far about these rules? And why isn't it not in this document?
In regard to the data that we get as of now, because reporting hasn't started for all asset classes and all participants, we actually don't have the complete data that would be necessary to run the calculation as we were able to based upon the data that we have.
Fair enough. What impact have the no action letters, et cetera, had on this and you coordinating and looking at the data? Is there, within the data fields, do you have a designate? Are people saying, not reporting subject to no action relief?
No, that's not a data field.
So you couldn't, in assembling this, you either have to know what no action relief we've offered or guess it to why that field isn't filled out.
Correct, but the way that it's working is that people will be backloading, and so as the backload is completed, we'll have a robust data set. So anyone who currently might have one of those reliefs that isn't a pass during this period of time, they'll be expected to backload and bring up their information to the same robust level as everyone else's.
At the expiration of the no action relief.
That's my understanding.
Okay.
I defer to one of the lawyers here.
That's
but
right.
And most of this no action relief kind of dissipates out over the next year or so, right? And of course, with Rick at the table, I do want to thank the DMO team. George, you've been helpful as well, and the ODT team, John Rogers in particular, after our TAC meeting, moving to the next steps about standardizing data, improving the quality of the data, and working with the SDRs to really put a finer point on this so we can use the data is an essential tool, because it's a huge missed opportunity if we've mandated all this and we don't fully utilize it. So I look forward to explaining my amendment when it's appropriate at the end of the questions, but I will end my questions here.
Commissioner Wiegand.
I just, for now, have one, possibly two questions. And I think we all can anticipate the answer, but is it possible that the ultimate thresholds in the post-initial period could be different than 67%?
Yes. Is it possible that the ultimate thresholds could
for the post-initial period could be something other than 67%?
I mean, not with the rule as it is, no. So the 67% notional amount calculation is what will be used to determine the post-initial block sizes.
Well, but there's a new provision in the document. I'll just read it. It says that the Commission notes that in response to either a submission or its own surveillance of swap market activity, the Commission may exercise its legal authority to take action by rule or order to delay the imposition of post-initial appropriate minimum block sizes, particularly with respect to swap categories in the other commodity asset class.
Page 90.
Right. That is correct.
That's all I have for now. Thanks.
Thank you, Commissioner Wiegand. I don't know whether, Commissioner Malya, you wanted to say something about your amendment before we call the roll on it, or because I think it's
love to explain.
It's made a motion, it's duly seconded, and before we call the roll, I didn't know if you wanted to say something.
So, to be clear, my amendment does not do anything to change the either 50% initial phase. So this is not delaying block rules. It does not change the FX or commodity levels set at the DCM equivalent. So we are going to have upon enactment of this 50% block levels. What it does require is that we conduct a study over a year's worth of trade data to decide whether the 67% or some other percentage is the appropriate level for making notional value calculations. That percentage will form the basis for setting the post-initial swap block levels that will be voted on by the Commission. The amendment also removes the delegated authority from the Director of DMO in setting the first post-initial block size, and requires the Commission to make this determination. So a year's worth of data, recommendation to the what the data tells us based on that, and then we vote on that. That's what this does. This does not take away the 50%. We will have block levels in the same manner. It leaves it up to the staff on how quickly, but we do require a minimum of 1 year, and the data must go out for public comment, which is an important feature to any of our APA features. So we will be making post-initial block determinations, whether it's 67%, 75%, 62%, whatever the number, whatever the data tells us. The staff recommendation after public comment will make a recommendation to us. We will vote on it and implement it at that point. That's all it does. It does not take away blocks. It does not radically delay and undermine transparency, et cetera. It is a fact-based decision.
If I could just make a comment, I think certainly from my perspective, looking at this from sort of the opposite perspective, when you have the data in front of you, a year's worth of data that will show you what percentage of transactions in a specific class will end up being blocks, it may give you a better judgment of where to set the percentage. So you may decide that 10% of transactions should be the threshold, and the percentage may end up being 70%, but it's based on the data.
All right. Commissioner Maya, I appreciate all the work that you've put into this and on this amendment. I am not able to support this amendment. I feel that the rule that's in front of us today and the staff recommendation is based on data. And it's also, I'd say for 4 or 5 other reasons, I am not supporting it. This rule today has benefited from significant public consultation. And as I mentioned, it's not the first time we proposed it. It's the second time, and we had the benefit of that first comment file to address ourselves to this issue. I think also, as you rightly noted, the commenters, and it's not a polling, but if there were 12 commenters that said 67% is correct and 14 were somewhere else, that seems pretty close to me. I mean, that's not like there weren't people that truly supported 67%. I note also what Commissioner Wiegand said, that was inserted and is in this very clearly on page 90 in the document, that we have this opportunity, whether market participants come in by petition or other facts come into us, that this commission, through appropriate orders and notice and comment and so forth, can do what you're suggesting in your document. But that we basically finalize today that in a year's time, based on additional data, it moves to 67%. We have set in place the formula, but that if people petition us or others come in, this commission, through notice and comment, can do something. I would also note 2 other things from the congressional record. Dodd-Frank said we had to complete these rules in 1 year. I think Congress meant something by that. They didn't mean that we would never come back and change them, but just that we had to put them in place. I do think, as all the commissioners have said at different times, that we constantly have to come back and look, do we change them, do we modify them, and so forth. And then just lastly, as we note in our document on page 15, that and this was just from the congressional record. I think it was from Chairman Lincoln, but it's in the congressional record. She noted that the guiding principle in setting appropriate block trades is that the vast majority of swaps transactions should be exposed to the public market through exchange trading. I mean, I think that's what this is trying to meet, that congressional intent, at least as expressed by one chairman that worked on Dodd-Frank.
If I may respond to a couple of those concerns, I don't disagree at all with Chairman Lincoln on this either. She said do it quickly. That's what we're proposing. We're just adding the requirement that we do it based on data and the facts. This rule automatically goes to 67%. Now, I wish if I wasn't, as I'm frequently on the losing end of a vote, and if I got to win the vote and still have the losing number of votes, then that would be an interesting outcome, which is kind of the way this rule came out. 12 were for it, 14 were against it, but a lot of them, including, and this is the craziest part, if you look on page, where is it? Page 87, there's a discussion about, page 83. A number of commenters expressed concerns regarding imposing the proposed 67% notional calculation prior to analysis of swap data collected by SDRs. Now, 2 of the entities in here are Barclays and Better Markets in this category that are really supporting a fact-based determination. And I think these are just fundamental good government kind of solutions that we can take from the data that we're collecting. This was a priority. Get the data out there. We're working to make the data better, and I support the Commission's efforts, everybody's efforts to make it good, robust data so we can really surveil the markets. This is not a delay tactic. This is the 50% block is effective upon this rule. This only says let's look at the data before we set the number.
And I think this rule in front of us is fact-based and has been exposed to the public and has also looked at data. And we went back when we reproposed and looked at significant data as it was available to us then. As we move forward, we can certainly, and I think at all times, look to whether we reconsider things. So I'm not able to support.
I'd like to make just a couple of comments. My 12th grade math teacher famously said, "There's more than one way to the mall." And I'm not going to pass judgment on whether this amendment is a better way to get to where we need to go or not. But I think with the benefit of a little bit more notice about the amendment, I could have gotten a better handle on this, which is I don't have a sense today what sort of procedural problems could arise by virtue of us adopting this amendment right now. Commissioner O'Malley just referred to a couple of comment letters, but I think I would need more time and the advice of counsel to consider whether or not this neatly and appropriately falls within the APA if we were to accept it, which is the main reason I can't support it.
Fair enough, but we would have, based on this requirement, a vote by the Commission to set the level based on public comment. So I think we would be not only with the letter of the law, the spirit of the law as well. So I won't belabor this point. I'm happy to vote and look forward to the positive outcome.
Mr. Chairman?
Yes, Commissioner Chilton?
I just want to say, I appreciate Commissioner O'Malley's effort, but I believe that what we have before us is based on facts and data and a fulsome review of the comments. So, and I echo your concerns, Mr. Chairman. But thank Commissioner O'Malley for his effort. But I think what we have is totally justifiable. Thanks.
I guess, well, we have a new secretary. So, Ms. Juergens, you want to call the roll?
This vote is on the amendment to the preamble language and the rule text to require fact-based determination of appropriate percentages of notional amount calculations. Commissioner Weejan?
No.
Commissioner Weejan is no. Commissioner O'Malley?
Yes.
Commissioner O'Malley is aye. Commissioner Chilton? Commissioner Chilton?
No.
No. Commissioner Chilton is
No.
no. Commissioner Summers?
Aye.
Aye. Commissioner Summers is aye. Mr. Chairman?
No.
No. Mr. Chairman, no. Mr. Chairman, on this question, the ayes are 2 and the noes are 3.
Thank you. Do I call you Madam Secretary? Ms. Juergens, do you want to call the roll?
No,
on this?
Mr. Chairman.
Sorry.
I make a motion to consider a second amendment. This amendment is, do I have a second on that?
Second.
Thank you. This amendment does not change the percentage at all. You want to hand it out? It says, in making the determination of 67% that we have set in this rule, that we will at least conduct a study beforehand and get public comment, and then have a commission vote. We also have protected the delegated authority as well to make sure that the commission has the opportunity to vote on this. So we keep the 67% in. We don't try to come up with another number, so we're protecting that number. So I just ask that we take a study, public comment, and vote on it. Did you give the Secretary as well? I promise this is the last one. Maybe. See how it turns out.
It being motioned and duly seconded, are there any questions?
I actually have a question for the team. I just want to confirm, because there were a couple of questions asked about this in the round of questioning for the final rule. Did we consider additional data from when we proposed the block rule until now finalizing the block rule? Because I thought that we used the exact same data, and maybe I'm wrong. I didn't know we considered additional data in trying to figure this out.
Right. We did not consider additional data.
thought that that's what I had understood, but then the comment was made that we considered additional data, and we did not. So I just wanted to confirm that.
Commissioner May, again, each of these amendments were only handed to us on the dais, but this one I have had less time with than the earlier one. But I feel I'm not able to support this amendment. Like Commissioner Weegan mentioned, I don't know what I would have done if I'd had this a week or 2 weeks ago, but I don't feel I can support this at this point in time. I do think that the Commission always has the opportunity to take petitions, to slow down the director of DMO or any director from doing something if they think it's appropriate. But I think the rule that we have in front of us is a good rule, and so I'm unable to support this amendment.
Mr. Chairman, let me just, for the benefit of kind of the public watching, so what this does, prior to establishing the post-initial appropriate minimum block size as well as the post-initial cap sizes, the Commission shall complete a study that will assess whether the 67% is the appropriate percentage to be used for the notional amount calculation after the initial minimum block size period has expired. If based on the study, the Commission determines that 67% is not appropriate for any asset class, it will determine an alternative percentage or percentages to be used for notional amount calculation. The Commission notes that it will be able to make an informed evaluation of the appropriate percentages since it now receives swaps data from SDRs. I won't go into the rest of it, but that's all it does.
See, I don't accept the premise. I think that we have made and are about to make an informed determination based on notice and comment and a full public record and data with regard to this. And so I'm not able to support this.
Fair enough, but with all due respect, the data is 3 years old and it was only 3 months worth of data. So, and that was only for financial products, nothing for FX and commodities.
Mr. Chairman.
Commissioner Chilton.
Mr. Chairman.
Commissioner.
Yeah, I mean, it took us 24 months to get to this point. So, it seems to me we need to move on this stuff and get it in place. And after my thoughtful 60-second review of the amendment, I can't support it.
Ms. Jurgens.
This vote is on the Second Amendment to require fact-based determination of appropriate percentages for notional amount calculations. Commissioner Weegan?
No.
Commissioner Weegan, no. Commissioner O'Malia?
Aye.
Commissioner O'Malia, aye. Commissioner Chilton? Commissioner Chilton?
No.
No. Commissioner Chilton, no. Commissioner Summers?
Aye.
Commissioner Summers, aye. Mr. Chairman?
No.
Mr. Chairman, no. Mr. Chairman, on this question, the ayes have 2 and the noes have 3.
Now, okay. Ms. Jurgens, could you call the roll on the question, I believe, the staff proposal that was motioned and duly seconded?
This vote is on the final rule, procedures to establish appropriate minimum block sizes for large notional off-facility swaps and block trades. Commissioner Weegan?
Aye.
Commissioner Weegan, aye. Commissioner O'Malia?
No.
Commissioner O'Malia, no. Commissioner Chilton?
Aye.
Commissioner Chilton, aye. Commissioner Summers?
No.
Commissioner Summers, no. Mr. Chairman?
Aye.
Mr. Chairman, aye. Mr. Chairman, on this question, the ayes have 3 and the noes have 2.
I thank you. Let me just say the ayes having it, or majority voting for it, we will send it along with any technical corrections to the Federal Register. And I want to thank John and George and Essen and Rick and Non. I assume that a couple of you, Rick and Non, you're staying at the table, maybe others as well. because the next presentation is on the staff recommendation on a rule called Made Available to Trade Process for Designated Contract Markets or Swap Execution Facilities to make a swap available to trade under the Dodd-Frank Act and the Commodity Exchange Act. I want to thank, we have some new colleagues joining at the table. I think I'm on, okay, all right. Rick Schultz, the head of the Division of Market Oversight. David Van Wagner, Deputy and Chief Counsel for the Division. Nan Nguyen, who is the team lead. Sai Srinivasan and Mike Pennick, who are both from the Office of Chief Counsel and have spent many, many months, nights, days looking at the economics of the swap execution facility rules, the designated contract market rules that we moved on last summer, and this important made available for trading rule. Do I hand it over to Nan? Is that right?
That's right. Thanks. Good morning, Mr. Chairman and Commissioners. Today's staff is recommending for the Commission's consideration rules that establish a process for designated contract markets, DCMs, and swap execution facilities, SEFs, to make a swap available to trade and establish a schedule to phase in compliance with the trade execution requirement under Section 2H8 of the Act. First, we'd like to thank our colleagues in the Division of Market Oversight, the Office of the General Counsel, and the Office of the Chief Economist for all of their hard work, advice, and support during this rulemaking process. The Available to Trade rule was proposed as a further notice of proposed rulemaking in December of 2011. The Commission hosted a public roundtable on the issue in January 2012. The Commission subsequently received over 30 comment letters on this proposal and held a number of meetings with market participants. The discussions and comments arising out of the roundtable and letters were informative and insightful and have led staff to suggest a number of changes and clarifications to the proposed rule. The statutory basis for this rule lies in Section 723 of the Dodd-Frank Act, which establishes the trade execution requirement under Section 2H8 of the Commodity Exchange Act. Under the trade execution requirement, swaps transactions that are subject to the clearing requirement must be traded on a DCM or a SEF unless no DCM or SEF makes the swap available to trade or the transaction otherwise is not required to be cleared. The final rules implement the trade execution requirement by allowing a DCM or SEF to submit a rule filing to the Commission stating its determination that a swap is available to trade either under the Commission's 40.5 rule approval process or the 40.6 rule certification process. In response to comments received, the final rules establish two prerequisites regarding its review of these determinations. First, the Commission will only review submissions with respect to swaps that are already subject to the clearing requirement. Second, the final rules require that a DCM or CEF submitting an initial determination must actually list or offer that swap for trading on its own trading platform or system. In making its determination, the DCM or CEF must consider, as appropriate, one or more of the following factors with respect to the swap. 1, whether there are willing buyers and sellers. 2, the frequency or size of transactions. 3, the trading volume. 4, the number and types of market participants. 5, the bid-ask spread. And 6, the usual number of resting firm or indicative bids and offers. The proposed rule included 8 factors, one of which would have allowed a CEF or DCM to consider any factor that it considered to be relevant. In response to comments, this factor has been withdrawn in the final rules. Another factor, whether a CEF or DCM will support trading in the swap, has also been withdrawn, given the adoption of the listing requirement. In response to commenters, the preamble to the final rules state that the Commission will, for an initial period of time, extend the review periods for these determinations, as permitted under Section 40.5 and 40.6, to 90 and 100 days respectively, to allow market participants to submit and for the Commission to consider public comments. The proposed rules also requested comment on whether a CEF or DCM should be allowed to submit a determination with respect to a group, category, type, or class of swap. In response to those comments, the final rules allow a CEF or DCM to do so, with discretion given to the CEF or DCM to define that group, category, type, or class of swap. However, such a determination must address how the factors apply to all the swaps in the group, category, type, or class that has been submitted to the Commission. The proposed rules also requested comment on whether a CEF or DCM, in evaluating a swap, should be able to consider activity regarding the same swap on other CEFs, DCMs, or activity in the bilateral market. In response to comments, the final rules allow a CEF or DCM to do so. Upon approving or deeming a swap as available to trade, the final rules clarify that all other DCMs and CEFs that list or offer that swap for trading must do so in accordance with the trade execution requirement in the Commission's regulations with respect to methods of execution. The final rules also clarify that subsequent CEFs and DCMs will not be required to submit separate determinations for that swap. The proposed rule had included and requested comment on a requirement that economically equivalent swaps that are listed or offered for trading must also be made available to trade and therefore subject to the trade execution requirement. In response to commenters, the final rules do not adopt this requirement. The proposed rules also request a comment on whether there should be a process by which a swap is deemed no longer available to trade. The final rules clarify that when all CEFs and DCMs that had listed or offered that swap for trading no longer list or offer that swap for trading, then the Commission will deem that swap as no longer available to trade. Given this clarification, the final rules do not adopt a required annual review of all swaps that are available to trade as had been proposed. The final rules also provide that the Commission will post all available to trade determinations on its website. The final rules also include a schedule to implement the trade execution requirement. This schedule was proposed in a proposed rulemaking in September of 2011, and the Commission received over 30 comment letters. The final rules adopt the schedule as proposed, which requires market participants to comply with the trade execution requirement at the later of the applicable deadline established under the clearing requirement compliance schedule under the Commission's regulations, or 30 days after the swap is deemed available to trade by the Commission. At this time, we would be happy to address any questions that you may have.
Thank you, Nan. I'd consider a motion to on the staff recommendation.
So moved.
Thank you. I don't have questions. I do support this final rulemaking to implement the process for swap execution facilities in designated contract markets to, quote, make a swap available to trade, or what has come to be known the MAT rule, though Matt is not sitting at the table. Today's rule also finalizes a separate Commission rule proposal on phased-in compliance for the trade execution requirement. So there's actually, this is one of those moments, I say this for the public, where we took two rules and we're pulling them together in one. Completion of these two rules facilitates the congressionally mandated and I would say critical reform promoting pre-trade transparency in the swaps market. The trade execution facility of Dodd-Frank requires that swaps be traded on CEFs or DCMs that, one, are subject to mandatory clearing, and two, made available to trade. Now, this commission made significant progress through many rulemakings, and we now have clearing requirements on 4 major interest rate markets and a number of credit default swap indices. Those are the indices that are at the center of last year's very public events around J.P. Morgan, Chief Investment Office, and what has been called the London Whale. Such platforms, these CEFs and DCMs, will allow participants the ability to trade swaps by accepting bids and offers made by multiple participants, with all market participants given impartial access. We've had impartial access or similar broad access to designated contract markets, but that is what Congress said would also be on these swap execution facilities. The MAT rule establishes, I believe, a flexible process for a CEF or DCM to make a swap available to trade. And I would note, while Congress mandated and had a very specific process for clearing determinations, Congress did not mandate that this commission have a process for this. It simply said in you'll tell me what the statutory language was. It 5H, what is it, or David? What's that, 2? Trade?
The trade execution mandate, 2H8.
2H8, that these 2 conditions, required clearing and made available for trading. So I think this flexible process is appropriate, that the trading platforms will determine first which swaps they wish to make available to trading on their platforms, and that these determinations will be submitted to the Commission either as self-certified or seeking approval under Part 40. We did actually propose something about made available for trading in the first CEF proposal back in December of 2010, or it may have been in the Federal Register in January of 2011. Is that correct, Nan and David?
Yes, it was originally proposed in the CEF.
And that would have allowed swap execution facilities just to put it up on their website with no Commission involvement. I think that this proposal, as modified through the comment process, is flexible but provides the public with ample public notice, an opportunity to be heard through the process, and the Commission process under Part 40 I think is appropriate. We also have a phase-in rule here. The phase-in rule we proposed in, I believe, September of 2011, and that got significant public comment. The phase-in would provide market participants with 30 days after the CEF or DCM self-certification process or rule approval had finished. And as that self-certification or rule approval process may take as much as 100 or so days, it's in essence 30 days after that process. And I know some of the commenters said that such determination should not be taken up until after there's a clearing mandate, and I support the changes the staff made also to ensure, as I correct it, David, that, you know, that says Dan on your card there instead of David? Yeah. That this MAT determination is only taken up after there's a clearing requirement. Is that right?
Yes, that's correct.
Okay. So I support the rule. Commissioner Summers?
Thank you, Mr. Chairman, and thank you to this team for all of your hard work and helping us navigate what what I always have considered a very significant determination for this commission. And I know it hasn't been easy to figure out how we apply the statute in this context, but this does determine what contracts will be mandated to be traded on exchange. So I think I can't over-exaggerate the significance of this process and the significance of the determination of this commission to allow CEFs and DCMs to be making the determination of what is mandated. My fear and I guess assumption has always been that everything that is mandated to be cleared will end up mandated to be traded on a platform because of the way we have structured this rule. And because we made broad clearing determinations, and I'm not saying that I disagree with that, but we made broad determinations in what's mandated to be cleared, there are a lot of contracts that I fear are not appropriate to be mandated, and I think will be subject to this mandate. I just have a couple of questions. Is there anything in our act or in our rules that would prevent a CEF or a DCM from making a MAT determination for an illiquid, off-the-run credit default swap as long as it trades once in a while?
Commissioner Summers, I think it's difficult, given the novelty of this process, to prejudge, which swaps are, may be deemed not made available to trade. I think what we have here is a process by which the CEF or DCM can submit its initial determination to the Commission with the factors that are in this rule, and to allow public comments for a period of time to come in, and on the basis of how the factors are applied and the explanation that the CEF or DCM gives us, along with perhaps different perspectives from public comments, that at that point we'll be able to make a determination as to whether the swap is available to trade or inconsistent with the Act or the regs.
Thank you. I appreciate that. But I also, I'm concerned that because there aren't really objective standards, that it's going to be difficult for the Commission and the Commission staff. The preamble says that satisfying any of the determination factors would sufficiently indicate that a contract is suitable for mandatory trade execution. How will a DCM or CEF satisfy any of the factors given that they don't incorporate objective standards?
Well, Commissioner Summers, we think that the factors are each of themselves indicative of trading liquidity. And what we have here, as I stated, is a flexible process by which we expect in a rule filing the CEF or DCM to give us a submission containing an explanation and analysis based on one or more of these factors, how that swap that they've submitted is available to trade. And as we stated in the preamble, that we expect that explanation to be clear and informative. And it's our hope and expectation that, we will get public comments on those determinations that will help us inform whether that swap should be made available to trade or not.
Thank you. As I said in my opening statement, I fear that this rule in particular has the greatest prospect of putting us at odds with some of our colleagues in foreign jurisdictions, because I fear that they will not adopt this sort of process. So once we know, especially those major jurisdictions such as Europe, once we know where they may be in making mandatory trade determinations, what process could the Commission take to make a step backwards from any of these determinations? How can we remove a swap from the MAT determination?
Well, as the final rules clarify, once all CEFs, one CEF or DCM may make the swap available to trade, and the trade execution requirement would apply if there are subsequent CEFs or DCMs that list or offer this swap for trading, and therefore they're subject to the trade execution requirement. When all those CEFs or DCMs have delisted that swap, it would be in our judgment that that swap would no longer meet any of the 6 factors set forth in the rule, and at that point the Commission would deem that swap no longer available to trade.
I think that's what I was afraid of, that as long as a CEF or a DCM continues to list a swap and it's already been subject to a MAT determination, there's no way to remove it from that determination unless the CEF or the DCM, this is a question, unless the CEF or DCM delists it.
Well, I mean, right. But in addition to that, the commission, because I thought when you started, you were referring to things that the commission could do of its own initiative. And I think of its own initiative, it could take 8A7 action vis-a-vis the various exchanges that list that product.
If you could elaborate on that, I'm sorry, I didn't understand.
8 non-paren A, paren 7 gives the commission authority of its own initiative to basically impose rule changes on CEFs or DCMs. So in this case, because the determination itself was prompted by a rule change, essentially you could reverse that by taking action vis-a-vis the exchanges that list that and basically say you want to unwind the determination.
So we could use 8A7 to only unwind the MAT determination, not tell them to delist it.
Yeah,
okay.
Theoretically, right.
Okay, thank you.
Can I just follow up? So, but it's the MAT determination that leads to a trade execution requirement. A simple listing does not. Just a
correct. Commissioner Summers, I'd also note, as we discussed in the preamble to the final rules, insofar there's a listing requirement for these swaps that are submitted to us as available to trade. They're submitted to the Commission initially as a product listing or a product filing under 42 or 43. And under the Part 40 rules, the Commission, are allowed to request of a CEF or DCM that's listing that swap additional information that would, hypothetically speaking, that would demonstrate that the swap continues to be available to trade.
Thank you, Commissioner Summers. I think that last exchange was very helpful, that 8A with some parentheses 7 can be used by this commission or future commissions to, in essence, address itself or reverse a MAT determination. David, do you want to just confirm that again?
Correct.
All right. Yeah, without requiring delisting, though.
Correct.
Right. Yeah. Commissioner Chilton? Commissioner Chilton, did you have any questions? I don't think we're here.
I'm sorry, the audio wasn't on yet. Yeah, sorry. How will folks be notified when a MAT determination has been made? I mean, there has to be some sort of market-wide dissemination, right?
Commissioner Chilton, as we know in our final rule, the Part 40 submissions, as with other Part 40 submissions currently, are posted on our website. And as we also stated in the preamble, that we plan on listing on a centralized area of our website a list of all the swaps that have deemed or approved as available to trade and therefore subject to the trade execution requirement. This would, we believe, give market participants notice of which swaps are subject to the trade execution requirement.
Okay, and will a DCM be able to trigger the trading mandate in advance of a CEF being registered? Can they trigger it like that?
No. What a DCM could do is, on the effective date, they could make a filing or make a determination and submit a filing to the Commission that swap's available to trade, but the actual trade execution mandate wouldn't take effect until after the Part 40 review process occurs and after the implementation period that we have for market participants to prepare to comply with the trade execution requirement passes.
Okay, thank you.
Thank you, Commissioner Chilton. Commissioner Amalia?
Thank you very much. Thank you to the team for trying to make this process workable with little congressional direction and advice. Can you provide an example of a cleared trade that you believe would be unacceptable to receive the MAT determination?
Commissioner Amalia, it's difficult to prejudge, which swaps, at this moment we would deem as, of at least the universe of cleared swaps, which ones we would deem as not made available to trade. I think it would depend on the swaps that CEF or DCM subsequently decides to list first and then to submit to us. And also, what we would expect to do is review the explanation analysis and how they've applied to the factors in that determination, and also look at the public comments before making that determination.
Could a CEF submit the entire rates curve for MAT determination as part of its grouping that they could submit? That provide in here?
Well, as long as the CEF is listing or offering swaps for trading that cover that curve that you speak of out to a certain year, then yes, it could submit all those swaps as a group type category or class. But as the final rule stated, they would have to apply at least one or more of the factors to all of those swaps and explain how the swaps in that grouping are all available to trade.
Do you see any reason why they wouldn't?
It's difficult to determine at this point.
Of the 6 criteria you've selected to make the MAT determination, do you believe one or more of these is relevant to our determination? More important, greater weight?
Well, as we discussed in the preamble to our final rule, we think that each of the 6 factors are relevant could be relevant to a available to trade determination, and as there all could be indicators of trading liquidity. But depending on the swap that's submitted to us as available to trade, one or more of the factors could be more relevant than the other, depending on the determination and how the factors are applied.
That is, I love all my children equally, right?
Perhaps, yes.
Yeah. So in the period between the compliance date, this is date 61, and the effective date, which is date 120, will we be using trade data, actual trade data, to make any informed decisions about an eventual MAT determination? And will we accept pre-Dodd-Frank, any trades that are occurring today, for example, as part of a MAT determination?
Well, Commissioner Amalia, the final rules state that we would consider the information, evidence or data that would come in a filing and perhaps with public comments. But to the extent that we have data or information available to us in our role, our market oversight role, and that would help inform us about whether swaps available to trade, I think we would be able to use that information in the review process. I think it would be we would have to disclose what information it is we use to make that consideration as part of the administrative record. And I think that this approach is consistent with our practice when we review other Part 40 filings. So
what about futures data? Would that be relevant? I know you don't have an economic equivalency requirement, but could a firm submit or a CEF submit as evidence of tradability futures data?
I don't think they're foreclosed from using it to make that argument. I'm not an economist, but I don't think they're foreclosed from using that data.
So, like our 6 factors, all data we view in a very similar no favorite children status. It's all good as long as it's data.
Yeah, I mean, it's
relevant trade data.
Yeah,
relevant to the topic.
It goes into the administrative record that the commission would consider when it makes that evaluation at the end of the review period. I don't think there's anything, and so it has whatever weight you eventually want to give it when you consider it.
David, can you go through this 8A7 process for delisting? Is there a notice and comment period? Is it does somebody submit a request, or is this a self-executing thing?
Obviously enough, it can be informally prompted by somebody filing a petition with us, or just basically complaining to the commission. The way the process basically, there are a number of steps. The commission itself would basically have to, the particular, presumably the particular swap that's in question, the commission would actually basically have to pose, send a letter to the exchange or the exchanges basically saying, why do you think that this continues to be made available for trading? And indication being that this is part of it. This would be an 8A7 letter, and the end result might eventually be the commission actually moving to change the rule. The DCM or CEF that receives it would have an opportunity to respond. The commission would consider it, and then if the commission wanted to force a rule change on the DCMs or CEFs involved, it would actually have to put out a Federal Register notice to that effect. There would be a comment process. I don't think there's any embedded particular number of days, but there would be a comment process. And ultimately, the commission would make a determination whether or not the made available to trade determination with respect to a particular product should stand. And if I remember correctly, it ends up even being in our regulations. We actually we had some years back, we had a number of regs which actually said the CBT must, or one of the Chicago exchanges must change a particular arbitration rule, and the rule itself was laid out in our rules. I can't remember whether that's still in 8A7 itself, but it's basically the commission imposing a rule on a DCM or a CEF.
And how frequently have we used that?
Very infrequently. I will not oversell it. It's probably been 20 years.
Okay.
But the threat is out there.
There you go. So the Clearport situation and with the energy contracts, and we don't have an energy clearing mandate, so therefore you don't have a mandatory trade determination pending. But it does, we have a lot of cleared contracts, right? Thousands of contracts that are cleared, yet the liquidity and the on-screen trading is a little light, so to speak. How do we create a mandatory trade determination in situations like that? How do we say that yes, we understand it's clearable. Eventually, these products, energy products, will be mandatorily cleared and required to be cleared. But how do we make a determination that there is sufficient liquidity to trade? And using Clearport energy contracts as an example.
Well, Commissioner, I think in your particular scenario would be up to the DCM or CEF that's listing these contracts to make the case to us based on the factors we've set forth that there is sufficient, I guess, or enough trading liquidity to deem it available to trade, and therefore subject to the trade execution requirement. And we would expect, with the public comment period we're offering, we'd have market participants weigh in on their thoughts on whether these swaps should be subject to the trade execution requirement.
And also the requirement, it doesn't go into effect or can't even be considered until there's a clearing mandate for these particular swaps.
No, I understand
so until
that.
that's done, there's really
No, this is more of a hypothetical, but eventually we'll get there. And I'm a big fan of data and comment, so. But I don't. It's really up to the CEF, is what you're saying.
Insofar as they're making an initial determination and then presenting their determination of filing for the Commission's review, that's their role in the process.
I have no further questions. Thank you very much.
Before I hand over to Commissioner Wiegand, I just want to note, I'm sure that Claire, Kelsey, and Macy are very happy to hear that you love them all equally. And I would say the same thing about Anna, Lee, and Isabel. So good going, Dad. Commissioner Wiegand.
If my 3-year-old had slept through the night last night, I might agree with you. I don't have any questions.
Ms. Juergens.
This vote is on the final rule process for a designated contract market or swap execution facility.
Oh, I'm sorry. Yes, we did, Commissioner Chilton, yeah.
Made available to trade under Section 2H8 of the Commodity Exchange Act, or CEA, swap transaction compliance and implementation schedule, trade execution requirement under 2H of the CEA. Commissioner Weejan?
Aye.
Commissioner Weejan, aye. Commissioner O'Malia?
No.
Commissioner Weejan, Commissioner O'Malia, no. Commissioner Chilton?
Aye.
Commissioner Chilton, aye. Commissioner Summers?
No.
Commissioner Summers, no. Mr. Chairman?
Aye.
Mr. Chairman, aye. Mr. Chairman, on this question, the ayes have 3, the noes have 2.
The ayes having it, the staff recommendation is accepted, and with any technical edits, it will be sent to the Federal Register. I thank you all for all this work. And I gather Mr. Schultz, Van Wagner, Saeed, and Mike, you're staying up too as well, right? And is Amir Zaidi coming up? Great. Do you want to take a break or anything?
I want to tell you that this is staff call.
Okay. When I'm supposed to ask this question. Okay. Who wanted me to do this? I want to introduce to the public the team that's been working on the swap execution facility role from the Division of Market Oversight, David Van Wagner and Amir Zaidi, from the Office of Chief of Counsel, Sai Srinivasan, and Mike Pennick, from our General Counsel's Office, Adrian Jovez, and it looks like Jonathan Marcus is joining us as well. Rick Schiltz from the Division of Market Oversight, I assume, will be joining us. I also just want to give a shout out to Bella Rosenberg, who had team lead this for a while before she went to work for Commissioner Amalia's office. Joe Suzuki, who's in Commissioner Weejan's office, who was on the team. It seems this team feeds the commissioner's offices. Riva Andriassi, who had been working on it initially, Mauricio, and others. There's a lot of people, Carlene Kim and Steve Seitz, who have been working on this role. But I thank you all. I know it's been a lot of long nights, a lot of consultation with all 5 commissioners and their legal assistants, and many a public comment. Who do I turn it over to? Amir. You've got the table.
Good morning, Mr. Chairman and Commissioners. Today, staff is recommending that the Commission approve for publication in the Federal Register final rules pertaining to the core principles and other requirements for swap execution facilities. I would also like to thank the many staff members who contributed to this final rulemaking for their hard work and dedication. I'll first provide a little bit of background and then go into the proposal and final. Title VII of the Dodd-Frank Act establishes a comprehensive regulatory framework including registration, operation, and compliance requirements for CEFs. Section 733 of the Dodd-Frank Act added Section 5H of the CEA, Commodity Exchange Act, which sets forth registration and compliance requirements for CEFs, including 15 core principles that CEFs must comply with in order to register and maintain registration as a CEF. Section 5H of the CEA also states that the goal of this section is to promote the trading of swaps on CEFs and to promote pre-trade price transparency in the swaps market. Section 721 of the Dodd-Frank Act added Section 1A50 of the CEA, which defines CEF as a trading system or platform in which multiple participants have the ability to execute or trade swaps by accepting bids and offers made by multiple participants in the facility or system through any means of interstate commerce. Section 723 of the Dodd-Frank Act amended Section 2H of the CEA, which sets forth a trade execution requirement in Section 2H8 of the CEA. Swaps subject to the clearing requirement and made available to trade must be traded on a DCM or CEF. On January 7, 2011, the Commission published for comment a combination of proposed regulations, guidance, and acceptable practices pertaining to CEFs. The Commission reviewed many comment letters from and participated in numerous meetings with members of the public in connection with the CEF proposal. The Commission also consulted with the Securities and Exchange Commission and international regulators on numerous occasions. This final rulemaking is informed by and benefits from those public comments and meetings. In this final rulemaking, staff is recommending that the Commission adopt many of the regulations that were proposed with respect to how CEFs comply with Section 5H of the CEA. However, as a result of public comments and meetings, this final rulemaking revises or eliminates a number of proposed regulations and in a number of instances establishes guidance and/or acceptable practices in lieu of the proposed regulations. In determining the scope and content of the final CEF rule, the costs and benefits for each rule were carefully considered in light of the public comments. In the interest of time, I'll give a general overview of selected aspects of this final rulemaking, and then we will be happy to answer any questions. Section 5HA1 of the CEA sets forth a broad registration requirement, which states that no person may operate a facility for the trading or processing of swaps unless the facility is registered as a CEF or DCM. This final rulemaking adopts a registration requirement for any person who operates a facility that meets the CEF definition. Accordingly, this final rulemaking states that any person operating a facility that offers a trading system or platform in which more than one market participant has the ability to execute or trade swaps with more than one other market participant on the system or platform must register as a CEF or DCM. In response to commenters' requests, this final rulemaking provides examples whether certain better understood categories of facilities fall within the registration requirement. In addition, consistent with the 2H8 trade execution requirement, swaps subject to the trade execution requirement, those swaps that are subject to the clearing requirement and made available to trade, are required to be executed on a CEF or DCM. The rulemaking also states that swaps not subject to the trade execution requirement may be executed on a CEF or DCM or an entity that is not required to register as a CEF. The final rulemaking also provides procedures for full and temporary registration. An applicant seeking registration as a CEF may request that the Commission grant the applicant temporary registration. The Commission will grant a request for temporary registration upon a determination that the applicant has filed a complete Form CEF and submitted a notice to the Commission requesting that the Commission grant the applicant temporary registration. Complete Form CEF means that the applicant provides appropriately responsive answers to each of the items set forth in Form CEF. Staff will not conduct a substantive review before granting temporary registration. An applicant may operate as a CEF under temporary registration upon a notice from staff granting temporary registration, but in no case before the effective date of these CEF rules. The final rulemaking adopts the minimum trading functionality requirement as noted in the CEF proposal, which is now termed an order book. An order book is similar to the definitions in the CEF proposal, that is, an electronic trading facility as defined under the CEA, a trading facility as defined under the CEA, or a platform in which all market participants have the ability to enter multiple bids and offers, observe or receive bids and offers entered by other market participants, and transact on such bids and offers. An entity must register as a CEF, an entity that must register as a CEF must ensure that its operations comply with this order book minimum trading functionality requirement. This final rulemaking also distinguishes between transactions that are and those that are not subject to the CEA Section 2H8 trade execution mandate and provides execution methods for each category. As I noted earlier, swaps not subject to the trade execution mandate may be executed on a CEF or DCM or an entity that is not required to register as a CEF. If a CEF chooses to list such swaps, defined as permitted transactions in the release, this rulemaking does not limit the execution methods that are available to market participants or require market participants to utilize certain execution methods for such permitted transactions. On the other hand, transactions involving swaps that are subject to the trade execution requirement must be traded on a CEF or DCM. This final rulemaking provides that transactions in such swaps, defined as required transactions in this release, and that are not block trades, must be executed on a CEF in accordance with the order book or RFQ system and order book execution methods. I previously described the order book, so I'll now go into the RFQ system. An RFQ system means a trading system or platform in which a market participant transmits a request for a quote to buy or sell a specific instrument to no less than 3 market participants in the trading system or platform, to which all such market participants may respond. This final rulemaking lowers the minimum market participant requirement from the proposed 5 market participant requirement to the final 3 market participant requirement. Several commenters expressed concerns about the risk with respect to information leakage and a potential winner's curse for the market participant whose quote is accepted by the RFQ requester under the proposed 5 market participant requirement. To address the concerns of commenters, while still complying with the statutory CEF definition and promoting the goals provided in Section 5H of the CEA, that is, pre-trade price transparency and the trading of swaps on CEFs, this final rulemaking adopts the market participant requirement of 3. This final rulemaking also provides a phase-in for the RFQ to 3 requirement to assist market participants and CEFs to make an efficient transition from the swap industry's current market structure to the more transparent market structure set forth in this final rulemaking. From the effective date of the final CEF rules until 1 year from the compliance date of these final rules, a market participant transmitting an RFQ for required transactions may transmit the quote to no less than 2 market participants. As I noted earlier, the CEF definition includes the phrase, through any means of interstate commerce. Given this phrase, the final rulemaking allows a CEF to use any means of interstate commerce, including but not limited to the mail, internet, email, and the telephone, in providing the execution methods for required transactions. The execution methods are technology neutral given the any means of interstate commerce language. However, regardless of the means of interstate commerce utilized, a CEF must comply with the Act and the Commission regulations, including but not limited to the execution methods, impartial access, audit trail, and surveillance requirements. The CEF proposal included a time delay requirement for cross trades that are required transactions. The CEF proposal set the time delay at 15 seconds. This final rulemaking notes that the purpose of the time delay is to ensure a minimum level of pre-trade price transparency for required transactions on a CEF's order book. The time delay requirement is similar to time delays in the futures markets for cross trades. The final rulemaking adopts the time delay requirement, but in response to commenters' concerns, allows CEFs to adjust the time period of the delay based on liquidity or other product-specific considerations. The final CEF rules will become effective 60 days after publication in the Federal Register, and there is a general compliance date of 120 days after publication in the Federal Register. That concludes my remarks, and we would be happy to take any questions at this time.
Thank you, Amir. I now entertain a motion to consider the staff recommendation on the swap execution facility rule set.
So moved.
I thank you. Once again, I want to thank the tremendous dedication of this team and the many people that have helped before we got here, and the dedication of each of the commissioners and their legal assistants. I do support this rule. I support this final rulemaking as I think it's a key to fulfilling the transparency reforms that Congress and the President came together and laid out in 2010. It's been subject to significant public input. I think the file shows at least 100 comment letters, but I'm led to believe that there's been more meetings with market participants than even comment letters, and that's all noted on our website. There's also been big public conferences that are called like CEFCOM. Do I have this right? CEFCOM 1 and CEFCOM 2 that a number of us on this panel have talked with. Congress included a trade execution requirement in the law, and this means that swaps that are subject to mandatory clearing and made available to trade would move to a trading platform. And so the swap execution facilities are quite important, along with designated contract markets, to fulfill that mandate. Congress also provided the swap execution facilities would allow multiple participants the ability to trade swaps by accepting bids or offers made by multiple participants, the so-called multiple-to-multiple provision. And I think that the public really benefits by transparency, that farmers and ranchers and commercial companies, municipal governments, and the like, whether it's a mortgage company or community bank or local insurance company, benefits from this transparency. Many end users will not be required to use this. If it's a non-financial end user, you get a choice, but you get the benefit of seeing that competition and transparency. And competition does narrow bid-ask spreads, and competition does benefit the marketplace overall and the economy overall. But it does shift some of the information advantage from Wall Street to Main Street. So it should be no surprise that the record shows that many dealers have had concerns about these rules because they have a different job than this commission has. This job's commission is to comply with the law, implement the law, but as Congress mandated, is to bring transparency to the marketplace. And as I think as Commissioner Weegan earlier noted, this is a very significant change, coupled with the other two rules that will bring significant transparency to this marketplace. I do believe that this rule also strikes an appropriate balance of flexibility. That flexibility I want to express in a number of ways. Though it does require an order book, and the order book means anybody in the marketplace who's guaranteed by a futures commission merchant, I should note, but who's guaranteed to do a trade, has the financial resources, can leave a live executable bid or offer on these platforms. And if they want to communicate to the whole marketplace, that's how they can do it. That's competition. It's very critical. But also, if they want the flexibility to just request from a small number of participants who are unaffiliated with them responses, they can do that as well. And they can do that with what's called the request for quote approach. There are other comments that commenters have raised with us about whether there is something called a workup, whether if you do a transaction at some level, let's say it's a $10 million or $50 million trade, can you add to it or work it up? And the rule appropriately addresses that and says swap execution facilities can have rules about workup so that all their market participants can benefit from that as well, to the extent they want to come in with a smaller transaction and then work it up. So I think it provides significant flexibility in that way. In addition, as Congress said, that in the definition of a swap execution facility, that it could be by any means of interstate commerce. This rule is technology neutral. Telephones work. Maybe it's because I'm 55 years old. But I think Congress made the decision, and we're just implementing that decision, that this rule is technology neutral, as long as there is an order book and somebody can do the minimum functionality around request for quotes, have an audit trail, and the other provisions of the rule. It's technology neutral. I do have a question for the team. I just want to ask specifically, David, if you can take this one up. We at the Commission in 2011 and 2012 issued a series of exemptive orders, and then subsequently I think the Division of Market Oversight issued a no-action letter which preserved certain exemptions under the Commodity Exchange Act until the completion of the CEF final rulemakings and various rulemakings on contract markets. If we adopt this CEF rule today, how will that relief measure now operate?
You're correct. There were a number of Commission exemptive orders, and then in December of 2012, the Division of Market Oversight issued a no-action letter 12-48, which basically permitted facilities that were relying on some of the old CFMA exclusions and exemptions. The ones we know about are exempt commercial markets and exempt boards of trade, but also there are markets that would have previous to now been opaque to us, like relying on 2D2 and provisions like that. So essentially, we are proposing that no-action letter is due to expire on June 30th. So if the CEF rulemaking is adopted today, the Division of Market Oversight intends to issue a follow-up no-action letter to that 1248, which would essentially extend the relief that was provided there until the proposed compliance date of the CEF rulemaking, which is 120 days after publication in the Federal Register. And the relief would end 120 days on that compliance date, unless, of course, one of these trading facilities actually have pending before us at that time a DCM or a CEF application. Essentially, the point of this relief was to transition these facilities to the Dodd-Frank regime, and they got to take a look at both the DCM and the CEF rules, and they decide which way they're going to go when they're moving into a regulated environment. So that's DMO's plan.
So in essence, your plan is to extend the relief that was granted earlier beyond June 30th to effectively 4 months after this gets in the Federal Register. And as Amir laid out, during that period of time, people can get temporarily registered, which is similar to notice registration.
Correct.
Thank you. Commissioner Summers.
Thank you, Mr. Chairman. I have a couple of different questions. First of all, on the effective date versus compliance date. And I think if you could confirm for me that what we had in our proposal was a 90-day, was it effective and compliance date in our proposal?
Correct. Yes, it was 90 days.
So now we're being a little bit more aggressive about this effective date. And I think if there's been one takeaway that we've gotten from many of our CEF meetings that we've had is to make sure that there's a level playing field established for those platforms that are currently operating versus maybe new startups that want to be CEFs, that they can be in a place where they all have the ability to start on the same day. So can I assume that the starting day for people that have applications pending before us would be on the 60th day? They could start.
Yes, depending on when applicants get their applications ready and submit them to us, they could submit them after the publication of these final rules in the Federal Register, and depending on our time frame of reviewing the applications, there's a possibility that they could be starting on day 60.
But then they have until the 120th day to come into compliance. So you wouldn't have to have an application in if you don't care about being one of the first movers.
Right.
As long as you have an application in before the 120th day, you're okay.
Right.
For those currently operating.
Right. So for, as David mentioned, those who are operating under the no action relief could still continue to operate under that no action relief and take additional time to get their application ready and submit it to us, as long as it's before the 120-day compliance date. And then we would review the application and grant temporary registration. And for entities that want to come in after 120 days, who aren't operating right now, they have the flexibility to do that as well.
Okay, and just to clarify for everyone that on the 121st day, if you are operating a multiple-to-multiple platform and you still don't have a application in to the commission, you would be found in violation of the act.
Correct.
I am a little concerned about how ambitious this seems for our staff to be able to potentially get through these registrations, even for temporary status, within 60 days, especially if we have everyone that we believe may want to be CEFs, 15, 20 of these different entities putting applications into us for temporary registration. I am concerned that 60 days is pretty aggressive for us. My next set of questions is with regard to a piece that was actually just added last night in a red line that considers my dissent from the proposal. And there's a footnote, footnote 117, that says that Section 13.2 will allow the Commission to consider if a broader model for executing on CEFs, consistent with the suggestion in Commissioner Summers' dissent, would be appropriate on a case-by-case basis in conformance with the CEA and Commission regulations, core principles, and other requirements for swap execution facilities. In my dissent, I suggested that the Commission had gone beyond the mandate by requiring that there be a minimum functionality for CEFs. If you could just explain to me how Section 13.2 will work on a case-by-case basis.
Section 13.2 of the Commission's regulations, from what I understand, allows any person to file a petition with the Commission to issue, amend, or repeal a rule. So a participant or a person could come in and ask for a rulemaking as far as the execution methods, or ask us to look at the execution methods and either issue a rule or amend what's in the current rules.
So potentially somebody could come in as a CEF and petition us if they don't have the minimum functionality requirement, and petition us to allow them to be registered as a CEF under 13.2.
Correct, but 13.2 is forcing, basically it's forcing a regulatory change. So during the pendency of any commission consideration of that petition, the reg that's being suggested there be revisions to would stand. So they would presumably, if they wanted to operate or continue operations, they'd have to comply with the CEF requirements.
Okay, thank you. And then finally, I have questions regarding the concept of exempt DCOs and exempt CEFs. So, sorry, Dodd-Frank has required me to use reading glasses because the thousands of pages that we've been going over has made me lose my eyesight. So on page 38, well, I'm sorry, this is potentially an older version, but we recognize that we're authorized to notice register SB CEFs under 5HA2 and 5HG of the Act. And we say that the Commission must comprehensively review and understand a CEF's proposed trading models and operations, which will facilitate trading for a more diverse universe of financial instruments and underlying commodities than SB CEFs could offer. But at this time, the Commission is not permitting notice registration given the differing requirements, and we also note that Form CEF may differ from the SEC's registration form. So we acknowledge that the Commission has the ability to notice register entities or exempt CEFs, and we do the same for exempt DCOs. There's a section in the preamble where we acknowledge that the statute clearly allows for the Commission to exempt CEFs. However, until such time as the Commission determines to exercise its authority to exempt DCOs from the application registration requirement, CEFs must route all swaps through registered DCOs. So we acknowledge that we have this ability, yet we don't set out any type of framework to allow these entities to be recognized as exempt DCOs or exempt CEFs. If you could just outline for me whether we have plans to do this or what the Commission intends.
Sure. You mentioned 5HG, and under 5HG, the Commission, as you said, may exempt a CEF from registration, but it's also if the facility is subject to comparable comprehensive supervision and regulation by the SEC, another prudential regulator, or governmental entity in the facility's home country. We note that at this time, the SEC or other regulators don't have comprehensive, comparable supervision and regulation for CEFs to what the Commission is considering today. So at this time, we're not going to consider exempt CEFs or allow for exempt CEFs, but it doesn't foreclose the possibility in the future that we could consider exempt CEFs. And also, as we discussed, 13.2 of the Commission's regulations, if at some time in the future a entity wants to come in and petition the Commission for a rule with respect to exempt CEFs, then Commission could consider it at that time.
What about entities that are just comparably regulated by the SEC or prudential regulators, not necessarily as an SB CEF? Have we made the determination that just because they're not currently being regulated as a CEF, that they're not comparably regulated as a trading platform? They could be registered as an ATS with the SEC and be comparably regulated.
We haven't made any determinations at this time.
Okay.
It's just that if those entities want to come in and petition, then we can decide at the time whether there's comprehensive and comparable regulation.
Okay. Thank you. And my last meeting wouldn't be complete without being able to put Ananda on the spot. So can I ask Ananda to answer the question about exempt DCOs?
I want to thank Commissioner Summers because I always enjoy this.
Thank you for inviting me, court reporter. My name is Ananda Radhakrishnan. I'm Director of Division of Clearing and Risk. Commissioner Summers is correct. The statute does provide for an exempt DCO, and the standard that the statute lays is comparable and comprehensive supervision and regulation by either the SEC or foreign regulators. To date, no one has asked the Commission or petitioned the Commission to exempt them as an exempt DCO. And if you're wondering why we don't have a process, it's a function of the fact that nobody's asked. And also because of the tremendous amount of work that not just DCR but other people have had, we believe it is time better spent dealing with issues that we've got to deal with rather than dealing with issues that might arise. The other consideration is as follows. An exempt DCO cannot legally segregate customer money, right? And if you look at the structure of the statute, for customers who want to trade and clear swaps, if they're not a direct clearing member of a registered DCO, they must go through a registered FCM. And the registered FCM is obliged to segregate customer funds. At the clearinghouse level, that segregation must also take place, legal segregation. Otherwise, in the event of a bankruptcy, there will be all sorts of issues, and it's highly doubtful that there will be customer protection. So anyone who's exempt cannot claim to legally segregate customer funds. They may be able to physically segregate it, but they cannot legally segregate it. So the reason I bring this up is if we do have exempt DCOs clearing for a CEF, then by definition that CEF can only transact dealer-to-dealer business. It cannot transact customer business because it cannot send the customer transaction to a DCO. So something for the Commission to think about, in considering whether to exempt DCOs. Is the Commission going to be satisfied having a dealer-to-dealer CEF? So,
thank you. And one last question on this point. If an entity were to ask us for exempt status as a CEF, is that a Commission decision or is that a decision that the division can make on its own?
Yeah. I believe under 13.2, that's a Commission decision.
Thank you.
Thank you, Commissioner Summers. Commissioner Chilton? Commissioner Chilton?
Yeah, thank you. Thank you, Mr. Chairman. On voice brokers, and Mr. Chairman, you spoke about being technology neutral, and we've heard it from staff, but since this is something that I've been really an ardent advocate for from the beginning, from the time we had the proposal, I just want to get a simple answer. Can we be assured that under this rule that voice brokers who have been executing trades will continue to be able to execute trades on a CEF?
Yes, voice brokers will continue to...
Thank you. That's good. That's all I need. Thank you. Okay, and the Commissioner Summers asked some good scheduling questions, but I had a follow-on. So under the proposal, would a platform operating prior to the registration have to stop trading like the day before they go live as a CEF? How would that actually work? That wouldn't make sense, right? That's not what we're saying.
Right. Commissioner Chilton, yeah, that's actually an interesting point, and I think that we just realized that there's a little bit of a gap here, and I think you're referring to the fact that you're an entity right now who's operating relying on the no action letter, and then you are temporarily registered on a particular day, and then as a CEF at that point, you would have to file all your products with us pursuant to Part 40, and that's actually a process that might take a few days. So I think that we probably have to take care of that in the no action letter that I described at the top of the meeting, or this segment of the meeting, to sort of cover that gap, because we certainly don't want there to be any exposure for somebody who's coming in to be a regulated CEF. So I think we're going to take care of that, but it's actually a very good observation. Thank you.
Okay, thank you, David. I have two others. On these workups, I'm okay with them, but like a lot of this, I'm a little bit reluctant. And what would we do to ensure that these workups, where somebody may go out for a small amount and then not have to go out for a full meal deal RFQ to work that amount up, what procedures or policies should the CEF have, or would we have as part of our oversight, to ensure that this isn't some big gaping loophole to get around going out for RFQs?
Sure. So first of all, the CEFs would have to have rules about their workups, and as far as how that mechanism would operate, and they would also have to have systems in place so that all the market participants can participate in the workup, and also that the information from the workup sessions are distributed to all market participants. Furthermore, workups can actually promote pre-trade price transparency, where all the market participants are able to participate in a workup session, and by having other market participants who didn't participate in the initial trade participate in the workup session, can actually promote liquidity as well.
Okay, so just to string it out a little bit more, so is there any potential, just think about this theoretically, any sort of fact pattern that where a trader might be out there and continually use the workups to, you could do a workup all the way up to the block size, right? So is there some sort of fact pattern that we would look at and that we could potentially take an action on, or would we have to amend the rules? I mean, it'd be consistent with the CEF rules, I suppose, but could we, for example, if we saw this fact pattern of people doing the workups and always going right up to the block size, for example, say, no, that's not what we intended, or would we have to provide some further clarity, either as part of a letter, or would we have to amend the rules?
Sure. Well, with respect to the block size, the proposal or the final rules note that workup trades, you can't just work up a trade to the block size and consider it a block. It would actually be individual trades. So, and you're
yeah, but I'm saying that as long as you are under the block size, you could work it up until that point. So as long as
Correct.
you keep it under the block size, then you put it out there for a small trade, and then you work all the way up just below
Sure.
the block size. And I want to, look, if that happens, sporadically, okay, I'm just concerned that people are going to try to drive a truck through the workup provision, and I know the CEFs don't want to do that. They're just happy to get rules.
Well,
but I also don't want to just allow it to happen without having some oversight.
Sure, and that's why opening it up to the whole market will probably mitigate your concerns there, because it's not just the two original counterparties who are, doing a small size trade and then working it up to almost the block size. It would be open up to the whole market. So other market participants could participate in that workup session.
Okay, thank you. The last thing I had was something that, and I prepared an amendment on this, but it doesn't look like I need one, assuming I get the answer I think I'm going to get from y'all. And that is dealing with this whole debacle with Bloomberg and maybe, having information that was sort of misappropriated from the terminals. And my question is, presuming that a firm like a Bloomberg would register as a CEF, then once they've done that, if we, smelled something fishy with this potential CEF, could we then go after them under 1.59 to further review, probe, investigate, etc., whether or not they misused material, non-public information?
Yes, Commissioner. Regulation 1.59 would apply to CEFs and CEF employees. They would have to have rules prohibiting their employees, governing board members, disciplinary committee members from misusing and disclosing material non-public information. And we could also pursue them. And I should point out, it's not in the Part 37 rules that are being considered today. That is by application of a number of rules which have broader application to not only CEFs but DCMs. And as a sort of a public service announcement to prospective CEFs, they should, beyond whatever publication comes out of today's meeting, they should look at 77 FR 66288, which actually has 1.59 and a number of other provisions that are going to be, more broadly applicable to CEFs and DCMs post Dodd-Frank.
Great. Well, that's why I asked. Good public service. Thank you, David. That's all I have, Mr. Chairman.
Thank you, Commissioner Chilton. Commissioner Amaya.
Mr. Chairman, I make a motion that my amendment that I'd circulated earlier be adopted.
So moved. So moved. Second.
Second.
Being motioned and seconded, it's part of the
Thank
record.
you. I'd like to follow up on two lines of questions that Commissioner Summers started, and this is the temporary registration. And I think we've made a lot of progress. I'm quite pleased with where we are, and I think Commissioner Summers raised a good point, with this new compliance and effective date split, the ability to put and approve the multitude of CEFs and put them in a position so there's not a competitive disadvantage as a result of either first mover or not being ready to go. How are we going to ensure that? She does bring up a good point, and it's certainly, if you look at our SDR track record, our ability to pencil whip an application seems to be endless. How are we going to learn from that mistake and not get in the same position that we found ourselves in SDRs?
Sure. Well, I'll note this process is very different from what they did in the SDR rulemaking. From what I understand, that process was there had to be substantial compliance with the requirements in the SDR rule. Here, it's just a complete application review. So basically, we're just looking for appropriately responsive answers to all the questions and exhibits in Form CEF, and we're not doing a substantive review like they did in the SDR space. So this process is meant to be an expedited process because, as you noted, a lot of CEFs could come in here and staff has resource constraints. So we're well aware of we don't want to drag this process out. So it's meant to be an expedited process for temporary registration.
I just ask because I can't remember the page number, but I think some of us have used the expression notice registration. I know technically it's temporary registration, but could you point to where we put that in the preamble?
Sure. The version
I see page 38.
I believe it's on.
I'm pleased to see this. The commission notes that there is. Or wait, no, maybe I have it
I
wrong.
believe it's on page 48, 47, 48.
47, 48. Okay.
Yeah. And there's also reference to it, I believe, on around page 46 too.
Now, do you want to kind of?
I just think that Commissioner Malia raises a very good point. We're resource constrained, and there's 15 to 20 aspiring swap execution facilities who are ready to get going. It's been nearly 3 years since Dodd-Frank passed and 2.5 years since this rule was put out. And as we all know, about 6 or 7 months since we've been debating it intensely. And we want to see that happen. We don't want our resource constraints to limit that. So and we've had a lot of discussions up on the panel, but I mean, David, you and Amir and Rick as the head of DMO, you've explained it to me that you're going to take these 15 or 18 applications that may come in, not do a substantive review. It's similar to a notice registration. And then over what might be a 2-year period after that, work with those CEFs and work with whether there's issues that might be there and how they have come in. Is that correct?
Yes, that's correct.
I think that's an appropriate compromise with the realities of our resources. I just think that's and coupled with the public policy imperative to get these entities to, in essence, be licensed or registered and operating.
Well, that's great news. I appreciate that. Obviously, it does require the prospective CEFs to do their job and put together a really adequate application to make sure they answer all of the questions that we're looking for. But the reality is that we're going to make sure that they've done their job, and then we can quickly approve them so we can have a good, robust, competitive market. Now, another area that I'm concerned, again, Commissioner Summers raised this, and it's the international differences, right? We're waiting on the MiFID rules. They have these MTEFs and OTEFs, which are different from the standards that we have, but they're not final yet, is my understanding, and it's going to take a year or two before they are final, at least in Europe, and it could even take longer in Asia. So there could be some differences. And one thing I don't want to create is a situation where we pass our rules and then not look back and make any corrections that we need to fix our rules to remain competitive internationally and to make sure that the liquidity resides here to the extent we can compete for it and it's transparent in our markets and people have the ability to transact domestically. It's a competitive business. I don't want to make any misunderstanding about that. And I know the Europeans and Asians are thinking about the same thing when they put their things together. But I do not want to put forward a rule that is cast in stone that we cannot have the opportunity to look back and make, a response in case we're left out and we're uncompetitive in this environment. Is there anything that that provides this rule to really go back and fix problems in light of the international situation?
Sure. I'll come back to Regulation 13.2 that petitioners can come or persons can come in here and petition for a rulemaking or to amend a rule such as these CEF rules. But also we've included in these final rules a review. Commission staff will conduct a review of the execution methods within 4 years of the effective date of the rules and provide recommendations to the Commission. So that could address some of your concerns there as far as...
I'll be honest, that is a study in 4 years with no requirement to make a recommendation or have the Commission act. And I'm a little concerned that is, that's just cover.
Commissioner May, if I can address a little bit and enter into a discussion here, if that's all right, on the international. I think that we've done a number of steps, but I agree with you that we have to stay ever vigilant going forward. But let me just mention some of the steps we have taken. I think as Commissioner Summers noted, we have clearly stated that a swap execution facility may also refer trades or execute trades that go to an exempt clearing organization, to which Ananda spoke to earlier. And I know Sarah Josephson, our new head of international office, was actually over in Europe. Was it earlier this week? Yes, earlier this week. And that was very constructively received. We have a lot more work, as Commissioner Summers noted, as to what processes. We don't have any applications. But I think that's an important way to keep swap execution facilities that might be registered with us competitive if, for instance, they might have international parties that don't necessarily want to come into a clearinghouse here and have some exempt DCO. I think that's very relevant to this. But I also concur with you that I think that we stay vigilant, whether it's through Rule 13.2 or any other means that people come in. The Europeans look close to passing their legislative initiative, but it will be nearly 3 years after our legislative initiative. And they will go forward with rulemaking, and sometime in 2014 or maybe 2015, they'll land somewhere around order books and request for quote models and all that we've debated here. And I share your view that this commission should relook at this and be open, because these are international platforms ultimately. Some of these swap execution facilities will be located actually offshore, which is fine as well.
Good. Well, it's reassuring to know that I have your commitment that we'll reopen this if we get in a kind of a regulatory imbalance here, because we are going first, and going first, you could possibly make some mistakes and overreach or underreach, frankly. But I want to be in a position that that this commission is doing this with its eyes wide open, and we're prepared to make adjustments if necessary. And while we haven't gone back to fix any of our rules that I would argue that need fixing, I will take you at your word and your commitment that we will revisit this one as well if we're out of kilter internationally.
I think it's appropriate. I also share your view with some of our others. We're going to have to go back. And we're learning. As you go from a law to a rule to actual compliance.
We can start a list right now.
Things get very granular. I know.
How about Part 45?
I know about Part 45. We actually apparently have a lawsuit on that, too. But on the swap execution facility, as other jurisdictions take this up, I think these will provide flexible means of liquidity and that market participants will come to them. But as you say, other jurisdictions set something up, if they're slightly different, we should really look at conflicts and inconsistencies and be creative about it.
Right. Well, being nimble and adjusting is a great opportunity. Thank you very much for that, Mr. Chairman. Now, it appears by reading the preamble that the rule will permit voice as an independent method of execution. Why wouldn't the rule expressly state so? We've had this discussion a little bit, but execution by voice is buried within the definition of RFQ. So why don't we just call it out A, B, C by any means of interstate commerce? For those watching at home, it's A and B and then some subcategories within B that provide for the voice. I'm wondering why we didn't expressly and specifically state it as a third prong.
Sure. As you noted, the rule text does provide for any means of interstate commerce, and it includes voice or the telephone in the rule text. When we came up with the execution methods for the required transactions, which are similar to what was in the CEF proposal, we looked at the CEF definition and also the goals in 5H of pre-trade transparency and also promoting trading of swaps on CEFs. And we also note the any means of interstate commerce language in the CEF definition. And we believe that by looking at the CEF regulatory regime as a whole and not in a vacuum of just looking at the CEF definition, that the order book and the RFQ in conjunction with the order book are the appropriate methods that meet the CEF definition and also the CEF regime in 5H. And as you noted, any means of interstate commerce is included in the CEF definition, and that also includes a telephone. So we are saying you can use the telephone to meet the order book or the RFQ system in conjunction with the order book requirements. So there can be a voice system as long as it meets those.
Excuse me. How do you execute on the phone?
Sure.
Is there the opportunity?
Can I try this?
Sure.
From the old Wall Street days, you say, you're done.
How do you, is it
I
acceptable?
buy, I sell,
say-
you're done. It's again
so
because I'm
walk me through-
55.
So walk me through done, backwards. So if Chairman Gensler wants to be done on the phone,
Sure.
and he wants to, and you have a requirement to interact with the order book and the RFQ, how does that function?
Sure.
Does he have to post something?
As we noted in the final rule, there's a couple examples of how this would work. I'll just go through one hypothetical. Say Chairman Gensler calls you on the phone and wants to execute a trade, and you're the CEF. You're a CEF employee. In keeping with the RFQ to 3 requirement, you would go out to 3 market participants to try to fill Chairman Gensler's order. And then you could use the telephone to go back to him and say, these are the 3 responsive orders. And also you have
to put, can I clarify something?
Sure.
As the RFQ employee, would you have to type his order into a screen?
No, you could.
You could call other people.
You could call other people on the telephone or use a squawk box or use email or chat and ping 3 market participants, and you can take that whatever responses you get back, either 1, 2, or 3, go back to Chairman Gensler with the responsive orders, and also telling him what is resting on the order book, and he can say, "I want this one," and you are done on the phone. So that's kind of one example of how it could work.
So I can say, I hit that bid or lift that offer.
Yes, you may.
And you would say, you're done.
Exactly.
Thank you.
Thank you very much. Can you explain how we treat EDRP, exchange for derivative positions, in this on a CEF? Footnote 216.
I have to, we got a comment from MFA, I believe, that essentially, it was not in the proposal, but there was a comment requesting that exchange of derivatives for, well, actually three particular types of EDRPs, exchange of derivatives for related positions, that the commenter asked to permit CEFs to list as an exception to the trade execution mandate. They basically analogized the 3 transactions to the types of EDRPs that Core Principle 9 permits on DCMs. So essentially, I mean, at the outset, we would note that Congress, obviously enough, in the context of DCMs, explicitly recognized exceptions to the centralized marketplace trading requirement for DCMs for EDRPs. There is the absence of any such exception to the trade execution mandate for CEFs.
Are they prohibited on CEFs?
Excuse me?
Did they prohibit them on CEFs?
No, they
They're
did
just
not.
silent.
Excuse me?
Congress is silent
That's
on this
correct.
issue.
Right. So So what we worked through was to look at each one, because they did not really offer any clear bona fide purpose in discussing them in their comment letter. And so there were two that essentially they didn't quite justify, or we didn't quite understand what the rationale for the exception would be. There was one in particular, I think, that had some, basically had some traction, and that is an EDRP, which would be a swap in exchange for a physical commodity. At this time, obviously enough, physical commodities are not yet subject to the clearing mandate, therefore not subject to the trade execution mandate. So they would not be mandated to be on a CEF and subject to the trade execution mandate. And even if they were, we would anticipate that most of them would be used by end users who would be exempted from the trade execution mandate. At the end of this little thing, we did recognize that there might be a possibility that non-end users might want to do this transaction in the future. And so we basically, in the release, indicate that we'll take it under consideration if and when physical commodity swaps ever become subject to the trade execution mandate.
So is there a process that people have to apply to get these things? To take advantage, to trade some sort of exchange for derivative position on a CEF?
At this point, there's nothing that explicitly recognizes them in the context of Part 37. No.
So what does that mean? So is there not a process that they would have to come back
clearly,
to apply?
The request was to make it an exception to the trade execution mandate when a swap is subject to the trade execution mandate. And we said at this point in time, because those swaps are not yet subject to the trade execution mandate, we were not going to be granting an exemption in advance of that fact. I mean, obviously enough, if there are permitted transactions that are involved, as the swaps are not yet subject to the trade execution mandate, a swap would, a CEF wouldn't be restrained from.
Okay, so.
Them, I don't think. Yeah, right. I mean, ultimately, they could always come to us with a no action request too, if they.
But that is not for a non-required transaction. They don't need to come to you for.
Well, I was jumping ahead to
Right.
when they might need it as an exception to the trade execution mandate.
Right. So they'd have to come ask for no action relief for required transactions.
Right.
David, I gather
Still a hypothetical situation, obviously.
Your point of view, and one that I support, is that this comment from, was it MFA?
Right.
This comment was sufficiently generalized that it didn't get down to this narrow point.
Right. I mean, we were.
But that when you get to the narrow point, you say, in exchange for a swap, well, that's what a CEF is about. But in exchange for swap for something that's physical, you note in the footnote that we don't have any required or clearing mandate of physical commodity swaps at this point in time.
Right.
If that were to occur in the future, many people would be out because they would be end users. But if it was a financial company doing a transaction with a financial company and it was cleared and required to be cleared, and they wanted to do an exchange for a swap for physical, then
ESP.
What would that be? An ESP?
I guess.
ESP. Then you note in the bottom of this footnote, for the aficionados, they'll end up looking at what? Footnote 219. That at that time the commission could consider it.
Correct.
David, is there another option using, if a CEF wanted to put it in their own rule book and use Part 40 to petition us? Would that be an acceptable use, or an acceptable application, I guess you?
I mean, I'd have to think about that one, but I mean, obviously enough, the words that are in the mouth of the commission in that footnote is not at this time. So
So we've created
if you accept
a lot
the
of
footnote.
uncertainty around where Clearport is and kind of how those are treated. And there's been a number of press articles recently about that, and there's a lot of uncertainty about what their standing is and how we're going to treat them, et cetera. It seems as though we're creating the same thing. If it's a non-required, what do we call this? Permitted transaction, anything goes.
Right.
But all of a sudden, when you get to a required, and what if those products that have been permitted all of a sudden want to leap to required? All of a sudden, we're back in regulatory limbo again.
Well, I take your point that there's issues on the DCM side in Core Principle 9. I guess in staff's view, that should inform us at this point in saying go slow before creating exceptions to the trade execution mandate.
Go slow and or create regulatory uncertainty doesn't sound like the same thing. And I think that's where we find ourselves on this one.
If I might, Commissioner Malia, wouldn't it be possible to take, if we actually had a physical commodity swap clearing determination, that as part of that process to at that time address ourselves to, now that we're doing this a year from now or 3 years from now or whenever we might, to simultaneously take up what to do about what staff is now calling an ESP, an exchange for a swap for a physical.
Well, that in and of itself is a better process than what we've provided in this footnote, because what we've provided in this footnote doesn't provide you the certainty. It doesn't say, oh, by the way, when you come in as a required from a permitted, that we'll consider this as a solution. It doesn't say that, and it would be really useful to say either you can use Part 40 or as part of, in part of a determination for a required transaction, we will revisit this issue.
With regard to exchange for swaps for physicals, as opposed to the broader request was more general, which could have included exchange for swaps for swaps.
Swaps or...
Yeah, that doesn't. But exchange for swap for physical is the question for you.
Could we just put in a sentence that says that this is a path to and how we address it, and warn anybody who might be considering, well, where does this really stand? At least we'll tell them, we're willing to consider it as part of the.
Well, I think as part of the administrative record, I'm saying right now, I think, and you're saying, I think that it's appropriate if we take up a physical commodity clearing mandate that at that time to consider this exchange for swap for physical.
Let's put those words in this footnote.
Well, if somebody found the transcript of what I just did, that's your First Amendment on this rule?
Well, I make a motion to...
No, that's your Second Amendment.
That would be my Second Amendment. But, I think that's just... What's the path forward? How might people, and I'd frankly be interested in the Part 40 submission. Could they, as part of that, and part of their rule book, say we're going to adopt these things? We think as a CEF that serves kind of this physical market, that we're gonna make this part of our solution and put it in the rule book, and then we'll have to review it under the Part 40 submission. That's another way of doing it. But you weren't as equivocal on that one.
I guess, I'm still thinking of it, but it seems to me that, again, this is obviously somebody coming in well in advance of even the trade execution mandate pertaining to any particular commodity yet. The trade execution mandate does have exceptions carved into 2H8, and it's for 2H7, the clearing exemptions, and there is not embedded any other exceptions that are akin to what's in Core Principle 9 for DCMs, which is obviously the analog that the commenter was trying to go towards.
But they're also not banned either. So
I'm sorry?
They're also not banned by Congress's...
In a case such as that, I would think that probably be wise to accompany, since there's some ambiguity around it, I would think it would be wise to accompany the rule submission with either a no action or a 4C petition for absolute certainty. I don't want to. I can't prejudge Part 40. Well, I can't prejudge Part 40 filings here.
So I'm a little uncertain. Are we going to change that they could submit this as part of it? Change the footnote so to reflect that as part of their submission that they could that's how they could address this for a required transaction.
Well, I think what I was suggesting, and I think is appropriate, is it concurrent with any future action of this commission on a clearing mandate for physical commodities, that at that time market participants could come to us, petition with regard to exchange for swaps for physical, the ESP part of it. And that I would be comfortable, and if people by unanimous consent, if commissioners by unanimous consent want to amend the footnote to add that type of language, I'm comfortable with that.
I'm comfortable with that as well. Thank you.
Is there any objection? Bart?
Thank you, David. Rick, can I ask a question on technology? There are 18 proposed CEFs that have been registered with the NFA to conduct their market surveillance. I've even toured the NFA market surveillance floor, and it was explained to me that with all the API connections, the NFA will be able to monitor across its registrants and see across all CEFs in real time, an effective real-time market watch room. Are we going to have that same capability?
No, we've never had the capability to monitor any markets in real time. I mean, it's all of our oversight has been on a T+1 basis, whether it's large trader or trade information.
Right. How will we interface with NFA to help them with their market surveillance?
Well,
are we going to expect each CEF to download its position and information data, or can we work with NFA to get a more comprehensive view?
Well, we'll be working with NFA. I mean, NFA is operating on behalf of the CEFs, who they've delegated the responsibility to do the oversight. We'll be getting information, from them as well as from the SDRs and from the clearing organizations for the swaps that are cleared. So it would be we haven't actually set up processes yet, but that's something as the CEFs start coming in, and if the rules are approved, we'd start working with them to get the information to do oversight. To some extent, the obligation is on us to do the overall oversight of the markets because each CEF is only responsible for its particular exchange.
Yeah, it's probably not lost on you, but that's only 60 days away. Do we have a technology strategy? Do we need to buy more computers, move desks, do something to prepare for that technology?
I don't know. I'd have to talk with John Rogers and others. I don't have that answer right now.
That's all I have. Thank you very much.
No, thank you very much. Commissioner Wiegand.
Thank you, Mr. Chairman. I don't have a lot of questions, just a couple here, but I thought maybe it might be helpful for the benefit of the public. I know your presentation got into this some, and my opening statement alluded to it as well as the chairman's, but it might be helpful, I think, to reiterate just what the key differences are between the environment we'll now see in light of the CEF rule and the related rules compared to the current OTC market. So a lot of focus has been paid to trading protocols, but what are some of the other things that might be useful to review as required in this rule that will bring some additional benefits to the public?
Sure. Well, in addition to the trading protocols that you mentioned, another requirement that will be in effect if these rules become final is the impartial access requirement. So all market participants will have impartial access to, that are ECPs will have impartial access to CEF's market. Another
Amir, sorry to interrupt, but with this, it might be, I'll just jump in with a follow-up.
Sure.
In rough terms anyway, how is impartial access going to be provided for or monitored by the Commission? How are we going to measure whether a CEF is permitting impartial access? What's the standard?
The impartial access standard is for a CEF to provide impartial access to ECPs and ISVs, so they have to have non-discriminatory rules in place when they're considering whether to grant access to ECPs. So the CEFs will have the rules in place, and then obviously we'll have our oversight authority to through rule enforcement reviews or other mechanisms to oversee that. A couple other benefits that I didn't mention in my remarks. There'll be audit trails and surveillance requirements that CEFs will be required to keep that is not necessarily true in today's OTC market. And also,
and again, sorry again to interrupt, Amir,
sure.
but why is that important? I mean, why is that an important reform that we as a commission today feel needs to be part of this rule?
Sure. Well, for the audit trail requirement, the CEF will have to be able to reconstruct transactions and keep audit trail from the time orders come in through the time of fill or allocation or other. So that's very important for our oversight responsibility to look into if there is some prohibited trading practices going on or other disruptions in the market. We can gain access to that data to find out what's going on, similar to the real-time trade monitoring that CEFs have to implement, and also automated trade surveillance as well. So that'll be very important to us for our oversight responsibilities, and my colleagues in DMO for them to review on a daily basis. A couple other things.
Again, just to interject again,
Sure.
I agree. These are important provisions. The benefits of pre-trade transparency are multiple. Obviously, one has a lot to do with pricing of these contracts, but through these other mechanisms and other requirements under the core principles of CEFs, it's also going to be extremely important to the Division of Enforcement as they monitor for manipulation, for DMO and surveillance as well. But these will all be very, very useful tools just to ensure against manipulation.
True, yes. Also, the CCO requirement for CEFs, that will also be implemented in these final rules when they become effective. And that's also another important aspect to these rules. So the CEF can have the rules in place. They can have somebody at the CEF overseeing the rules, and also the compliance measures that we just went through. So that's another important aspect to these rules that is not in place today in today's OTC market. And also just from another aspect, the clearing, there'll be mandatory clearing, obviously, that has started to take into effect right now, and the real-time reporting that's will be in effect when the CEFs get up and operating. So there's many benefits that these rules will provide for the marketplace.
Thank you for going through that.
Can I just add one thing, because we sort of forget? I mean, obviously enough, CEFs were building out the requirements that they have, but I mean, at the outset, when we were talking about the no action letter and some of the entities that are relying right now on that no action letter because they were relying on CFMA exclusions and exemptions, I mean, there are markets that we literally do not know who they are prior to Dodd-Frank. I mean, they relied on 2D1 and 2D2 to trade interest rate swaps on trading facilities and non-trading facilities without any notice to us, obviously no data provision, et cetera. You know, since Dodd-Frank, there's obviously reporting requirements that have kicked in, and then moving them to a regulated space. So that's, I think, we get lost in the details as far as the big picture changes that have happened post Dodd-Frank.
I agree. I appreciate you pointing that out. And again, as it relates back to protocols, the trading protocols, I said in my remarks I thought it was important. I thought that Congress is informing or directing the Commission to be flexible in that regard. And again, I think we've provided for appropriate flexibility in this rule. But in any event, isn't there a baseline level of pre-trade transparency that's always going to be required or met by virtue of us requiring trading protocols in the first place? Again, in a way that's different from what we might see in the current OTC space.
Sure. So for required transactions that are subject to the trade execution requirement, we've laid out those the baseline execution methods that market participants and CEFs will have to comply with, and we've taken into account the pre-trade price transparency goals of Section 5H, and we believe that, as you said, it provides appropriate flexibility to CEFs and market participants.
But Commissioner Wiegand, if I can add, I think that even parts of the market that are not required to use a CEF will benefit, because there will be an order book there. And if somebody wants to leave quotes, that will be relevant to their thinking too. They'll be able to see that. They might not execute against it because they're permitted not to. But I think that just actually having a place that any market participant can come to, who of course is appropriately guaranteed to be there and so forth, that really is a big part of this benefit, well before you get to whether it's a required trade execution mandate swap, well before you get to whether the request for quote model is 2, 3, 5 or something else. So.
Well, and similarly, again, I alluded to it in my statement, but there might be some enhancements to risk management for clearinghouses and clearing firms alike.
No, I agree with that, because I think as the Congress said that so much has to come to clearinghouses benefit by having that available pricing data as well as the liquidity that swap execution facilities will provide, and it will lower some of the risk of clearinghouses. And I think that's a major, when we think about cost and benefits, that's a major benefit, that clearinghouses, this will help lower their risk.
Yeah, I appreciate the staff working with me on this exchange. Again, the moment we're at right now as a commission is pretty important and transformative, and I thought it was useful for the public to just understand a little bit better in more detail all the different ways this rule set today brings about reform. So I appreciate that. That's all I have.
Before calling the roll, I didn't know whether you, Commissioner
I'd like to explain what my amendment does, and be happy to entertain any questions. So this is very similar to what we've discussed in terms of block rules. This is a data requirement that would require the Commission to conduct a study based on a year's worth of swap trade data in order to make an informed decision about the appropriate minimum RFQ requirements. Based on this study and after public comment, the Commission will be required to vote on the appropriate changes based on the recommendations of the study. My amendment binds the Commission to act before 2 years, but there is no requirement why it can't act prior, so long as the completed study has had the benefit of public comment and review. Obviously, it goes without saying, we've discussed it here at the dais. It was by requiring the Commission to act in this amount of time, and after some time has gone by in terms of moving this, we would also have the opportunity to see where Europe is in terms of its RFQs. And we would obviously have a forcing mechanism to adopt to our rules in light of the MiFID final rules. This amendment does not change the bias of the rule towards a minimum RFQ of 3. It simply ensures that we undertake our appointed responsibilities, and they are done so based on the facts and the data before us. So if anybody has any questions or concerns, let me know. I'd be happy to answer them.
Just to clarify, this does not do anything to the timing of the CEF rule. The CEF rule will still go into place. It just requires us to look at the data before the RFQ automatically goes to 3.
That is correct.
I guess, sorry, one more question. In looking at the data, the commission then would have the ability to decide whether some more liquid contracts would be appropriate for a higher RFQ versus a lower RFQ number for more illiquid.
The facts and the data would tell us.
I'm not able to support your amendment, Commissioner Amalia. And we've come a far way, this commission and you and I have, in these 3 years of discussing this. I think that this commission included, at your good suggestion in the initial proposal phase, a request for quote model, recognizing we would provide market participants flexibility in the swaps market that was not necessarily in the futures market. That request for quote model was appropriate, and I still support that we have a request for quote model. Here, in the futures market for the public, if you want to request a quote, the information has to go out to all of the market, and the responses come back. Everybody gets to see that. Fairly different here, what we proposed is you could go out to a minimum of 5, and the responses didn't have to be shared with the market. I feel that based on the comments and the public record that we've come out in an appropriate place based on the data and the facts that we know it as of May 16th, 2013, is that there's a request for, quote, minimum of going out to 3. Now, if the 3 parties don't come back and only 1 comes back, you can execute by any means of interstate commerce. For a phase-in period, which is approximately, about 16 months? Is it 1 year from the 4 months?
It's 1 year from the compliance date, so about 14 months.
Well, isn't the compliance date 4 months?
Yes, sorry. Yeah, you're right, sorry.
I'm sorry. All right, so 16 months. Has a phase-in at 2 that, again, helps the market adjust if there's any adjustment. I feel that it's appropriate. I would note that these are highly liquid markets because we've already determined that they're under the clearing mandate. And one of the 5 factors that Congress asked us to determine, and we went out to notice and comment, was the liquidity of these markets. But I would further note that we have 77 registered swap dealers, and 66 of them registered before December 31st, which meant that they passed the de minimis of $8 billion of trading, and that was an annual de minimis. They passed in just 18 days in October of last year. Now, of course, that's not necessarily 77 independent, unaffiliated members, but I think it's 35 unaffiliated members. And this is that they are registered and making markets as dealers in the credit derivative indices and the interest rate markets. I also feel it's an appropriate balancing because each of the market participants could, if they wish, also have other means available to them. They can use the order book. We have a crossing rule that was proposed and is still in here. Some people call it the 15-second rule, but a party could one-on-one do a transaction and bring it to the swap execution facility, and the swap execution facility, by any means of interstate commerce, would have to note that a cross was happening, and somebody could improve on it. This is a mechanism that's used with quite success in the options market, options on futures markets today. And as we talked earlier today, there's also the workup rule. To the extent if somebody feels that they would somehow have a bit of a winner's curse or something on something, they could come in, let's say at 50 million rather than 300 million, and then work up the transaction without going back to 3 parties. So I think it's an appropriate balance, and I'm going to continue to support what's in the staff recommendation, and with all respect, decline to support your amendment.
Yeah, I was just going to make a couple of quick comments too. Over the course of the last week or so, we've spent considerable time carefully calibrating all the words of the preamble, to make sure that this is a bulletproof document in some respects. And so again, my fear here is that without the benefit of the sort of labored study and analysis that we've gone through over the last week or so and making the final edits to the rulemaking, I worry that by accepting this amendment now, without that same level of analysis, we'd be taking a risk that I just can't well tolerate at the moment. In other words, I don't want to delay this rule any further and bring about some of the uncertainty that we're resolving by adopting this rule today. And so I think the policy we've struck here is appropriate in this rule. Again, there's a number of different ways we could have done it, but we've settled on where we've settled, and so I'm gonna have to reject the amendment as well.
Well, go ahead.
I just have a couple of comments. I think certainly based on everything that we've been reviewing over the past 2.5 years to be able to get to the place we are, the data that we have been receiving even over the past 4 months has shown us that the contracts that are now being cleared and reported are not all liquid contracts. So being able to use the data and to consider the data and how we set the RFQ, I think, would be helpful to the Commission, and I'm hopeful that if this amendment doesn't pass today, that future commissions will consider the data when making any determinations.
Okay, just one quick follow-up. I think Joe made an excellent point, and we actually do have in the rule a requirement that the Commission do conduct a study, and the purpose of the study is going to review the trading protocols that are contained in the rulemaking today and to review whether they've been appropriate in light of what the Commission sees after some amount of time. I don't remember the exact amount of time laid out by the rule. So I think that's an important part of this rulemaking as well that gives me a little bit more assurance that we've landed in an appropriate place.
Let me respond to both the chairman and Commissioner Wiegand. You're right. We do have a 3-year study in here. It's exactly 2 years after we make a decision, unfortunately, or a decision is just automatically made for us, actually, based on this rule. The other thing that I think you highlighted, Mr. Chairman, was that transparency. That's what this is about. We insist that the market have pre-trade transparency. You mentioned the 15-second crossing rule. We mentioned the RFQ. We make sure the industry does all these things for transparency, yet we don't spend a single second to consider the data before we make a decision. And I think it's just upside down. And I'm disappointed that we're not going to take the data, make the decision, but let's vote and figure out where we go. But I certainly hope going forward that we will consider the data more carefully.
Just to follow one last step, I agree with Scott, and I think the study that's part of the rule has to be taken very, very seriously, and I expect and hope and believe that Commission staff will in fact do that.
And I expect that the Commission staff and the Commission will do that. I do feel that we've taken to heart all of the obligations we have, though it is 3 years and Congress gave us 1 year to do this. And we have considered the data at the proposal stage and at this possible point of finalizing this rule. I didn't know if Commissioner Chilton had anything before we called the roll. I just want to make sure. Commissioner Chilton.
I'm still holding my nose and biting my tongue. I think I'll just be quiet here. Thank you. No.
Ms. Jurgens.
This is a vote on the amendment to require fact-based analysis of RFQ minimum. Commissioner Wiegand?
No.
Commissioner Wiegand, no. Commissioner O'Malia?
Aye.
Commissioner O'Malia, aye. Commissioner Chilton?
No.
Commissioner Chilton, no. Commissioner Summers?
Aye.
Commissioner Summers, aye. Mr. Chairman?
No.
Mr. Chairman, no. Mr. Chairman, on this amendment, the ayes have 2, the noes have 3.
All right, so, Ms. Jurgens, you can call the roll on the base recommendation that had been duly motioned and seconded. Swap execution facility rule.
Yeah, this is the final rule, core principles, and other requirements of swap execution facilities. Commissioner Weejan?
Aye.
Commissioner Weejan, aye. Commissioner O'Malia?
Aye.
Commissioner O'Malia, aye. Commissioner Chilton?
Aye.
Commissioner Chilton, aye. Commissioner Summers?
No.
Commissioner Summers, no. Mr. Chairman?
Aye.
Mr. Chairman, aye. Mr. Chairman, on this matter, the ayes have 4, the noes have 1.
The swap execution facility rule with the ayes in the majority with technical edits and that unanimous consent amendment on footnote 219 will be sent to the Federal Register. I want to thank all the team. I want to thank my fellow commissioners. This is all, I will say, just part of a journey, and I do concur that we have to be open, whether it's because of international regimes, new data as it becomes available. This is a paradigm shift for the American markets that will bring transparency, but we have to be open to revising based on new information along the way. David Meister is coming, but does anybody want to break, or should we just get on and just do it? All right. We've deliberated, and David Meister is here. We have in front of us David Meister, the head of the Division of Enforcement, Robert Peace, who is in the Division of Enforcement and who have worked on a staff recommendation on a interpretive guidance with regard to disruptive trading practices. So I hand the floor over to you, David.
Thank you, Mr. Chairman. Thank you, Commissioners. Today, the staff is recommending that the Commission issue a final interpretive guidance and policy statement, or interpretive statement for short, concerning the Commission's prohibitions of disruptive practices. I'll summarize the highlights of the interpretive statement, and then we'll take the Commission's questions. In the Dodd-Frank Act, Congress adopted a provision prohibiting certain disruptive practices. The provision took effect on July 16, 2011, and it applies to violations arising after that date. The provision prohibits 3 types of conduct on a registered entity. First, violating bids or offers. Second, recklessly disregarding orderly execution during a closing period. And third, spoofing, an example of which is given in the provision as, quote, bidding or offering with the intent to cancel the bid or offer before execution, close quote. This Dodd-Frank law, now numbered Section 4C(a)(5) of the Commodity Exchange Act, is an important and welcome new enforcement tool to be used against persons who employ these disruptive practices which harm the critical price discovery function of CFTC regulated markets. It can and will be used in furtherance of the Commission's core mission to protect market participants and promote market integrity. This Dodd-Frank provision provides the Commission with rulemaking authority, but it does not mandate the promulgation of rules. Nonetheless, beginning in November 2010, the Commission took steps to inform the market as to how the Commission interprets and intends to apply this provision. Those steps, which included a public roundtable, an opportunity for the public to submit comments in response to Commission proposals, are now culminating today with today's recommended interpretive statement. As a threshold matter, the interpretive statement sets forth the Commission's interpretation that all three categories of prohibitions apply only with respect to violations on a registered entity, such as a DCM or a CEF. They do not apply to bilateral, off-exchange trades conducted in accordance with Commission rules. Taking each of the three types of prohibitions in turn, the highlights include the following. First, with respect to the prohibition on violating bids or offers, the interpretive statement makes several points clear. When a person buys on a registered entity higher than the lowest price offered or sells lower than the highest price bid, the Commission's interpretation is that the law is violated regardless of the person's intent. This conduct is disruptive. It impedes the price discovery function, and therefore Congress made this a per se or strict liability offense. The interpretive statement also makes clear the Commission's policy that there are limitations on the reach of this first category. For example, as to CEFs, the prohibition on violations of bids and offers applies only when a person is using the CEF's order book, but not with respect to other CEF execution methods, such as a request for quote system. The provision also does not create a best execution standard between different trading platforms within a particular DCM or CEF or across multiple registered entities. Second, with respect to the prohibition concerning orderly execution during the close, the interpretive statement makes clear that the Commission interprets this to cover not only intentional but also reckless conduct. It also makes clear that the violative conduct does not necessarily have to be undertaken during the closing period. Reckless, a common term in the law, means conduct that departs so far from the standards of ordinary care that it is very difficult to believe the actor was not aware of what he or she was doing. The closing is a particularly important period because many derivative contracts are valued based upon closing period prices. The interpretive statement confirms what the Commission understands closing period to mean in the context of this provision. As to what is orderly, the interpretive statement highlights that the fundamental concepts of orderly trading are similar in the CFTC regulated markets and the securities markets, and that there is a substantial body of judicial precedent applying the concept of orderly trading in the securities markets. The interpretive statement sets forth the policy of the Commission to be guided by, but not controlled by, that precedent. And now third, with respect to the prohibition of spoofing and similar practices, the interpretive statement makes clear that the Commission intends to apply the provision only when the actor engages in intentional conduct. It does not cover reckless conduct. This limitation flows directly from the statute. The interpretive statement states that the Commission's position that it intends to employ this The interpretive statement states the Commission's position that it intends to employ this prohibition against a person who, at the time he or she places an order, intends to cancel it prior to execution. The interpretive statement provides that the statutory prohibition applies to conduct on all registered entities, regardless of the trading system. It can apply to partial fill situations, and it can apply to one instance of misconduct or to a pattern. On the other hand, the interpretive statement makes clear that the Commission does not intend to apply the prohibition to good faith order cancellations or modifications. The statement lists 4 possible examples of violation of violations under this spoofing paragraph of the provision, but these are just by way of example, and they do not limit the Commission's authority to consider the facts and circumstances of a given situation to determine whether the conduct meets the elements of the law as provided by Congress. One of the Commission's core missions is to protect against disruptions of market integrity. In that vein, staff believes that this interpretive statement, which takes into consideration comments that we have received and constructive dialogue with commissioners, will help market participants abide by the law. I'd like to thank my staff colleagues who worked on the interpretive statement and other prior initiatives on this project and on this subject, Vince McGonigal and Bob Pease from the Division of Enforcement. Now, with that, I'll entertain any questions that you may have.
I'll entertain a motion to adopt the staff recommendations on disruptive trading practice guidance.
So moved.
I support the interpretive guidance and policy statement with regard to disruptive trading practices for swap execution facilities and designated contract markets. Now, as part of reform, Congress actually included a new section about various abusive practices, the three that Mr. Meister just went through, and expressly prohibited certain activity. And what we found after Dodd-Frank passed is many market participants asked, what does this mean? And we went out and we actually had a lot of discussions, and we had an advance notice that we put out with 17 or 20 questions. Is that right, David?
I think it was 19, Mr. Chairman.
19 questions. We had a round table, and I think separately it also probably came up at the Tech Advisory Committee a number of times as well, if I remember, Commissioner Amaya. But based on that round table and the advance notice and some of the advisory committee, then we put out this proposed interpretive guidance. And I think that it's helpful to the markets. The guidance addresses the comments the Commission received during that process, and I support it. And I have a longer statement that will go on the record, but I'm going to let others ask you questions. Commissioner Summers.
Thank you, Mr. Chairman. I just have a couple of questions. One is specifically to the disregard for orderly execution of transactions during the closing period, and the guidance recommends that market participants should assess market conditions, and I'm just wondering if you could give us a little bit of color on that, because market conditions are constantly changing, and one market participant's view of a market condition versus another one could be very different. How are we going to evaluate whether a market participant adequately assessed market conditions?
The guidance provides the language that you're talking about. I look at that in terms of the overall interpretive statement that says that this applies to reckless conduct, and reckless is defined in the rule as I said, it's sort of departing very far from the standards of ordinary care. And so under the law, what people do in determining whether or not someone acted recklessly is they look at what did the person observe, what did the person try to observe, what is the evidence that reflects on the person's mental state. One thing that we suggest, and the statement says that one ought to look at is, what does the market look like at the time that you're entering the market? It's really, that's a long way of saying it's really all wrapped up in an assessment of whether or not one acts recklessly. And as I say, the word recklessly is a common word in the law. It appears elsewhere, actually, in the Commodity Exchange Act as well, and it appears in many statutes and across the spectrum of the law. And ultimately, the assessment of whether or not someone acts recklessly does depend upon in part, what the person knew and was observing at the time.
I also wonder, because our registered DCMs did comment during this process, and I wonder whether or not we've reviewed the exchange's trade practice rules to make sure that this guidance, it doesn't conflict with what exchanges may have in their own rules?
We certainly did review all of the comments. We received more than 50, and we received some, I agree, from registered entities. It's the goal of this guidance to give the market and market participants an understanding as to how we interpret the statute. But I will say that whether or not the statute conflicts with a DCM's rule, and I'm not saying that it does, we would still be bound to apply the statute as written.
Of course. I'm just saying if perhaps something that may be conflicting or confusing in an exchange rule, conflicts with the guidance that we've given here, I assume that the exchange will just have to change their rule.
Well, I think I would agree. I mean, if the exchange has written a rule, say, making lawful spoofing, just by way of example, but without getting into something grander, or some sort of conduct that violates the congressional statute, I think it would behoove them to change the rule as well.
Thank you, Commissioner Summers. Commissioner Chilton.
Thank you, Mr. Chairman. Mr. Meister, with regard to the cheetahs, with regard to HFTs, since they don't have phone messages that we would, recordings that we would get, or maybe instant messages, what sort of circumstantial evidence would you look for spoofing for those guys?
Thank you, Commissioner. Your question about circumstantial evidence is a good one. Just to remind everyone, under the law, the weight of circumstantial evidence and the weight of direct evidence is the same. And what we would, and we often in the Division of Enforcement rely on circumstantial evidence. Circumstantial evidence can take various forms, including pattern of trading. It could include, for example, how a particular algorithm is coded. For example, if an algorithm was coded to cancel trades from the get-go. In other words, if an algorithm was coded that before an order was placed, there was an intent to cancel it, then that would be a level of circumstantial evidence that we would actually definitely look at.
Thank you. I'll put on my Scott O'Malley hat for a minute. Do we have the tools, the technology tools, to really detect this sort of in a on a real-time basis? I know we can go in and respond to complaints, referrals that we get, but do we have at this point the technology tools available to detect this? And I'm particularly interested in it, by the way, during the closing period. I know you addressed this a little bit, but give me a little bit more flavor.
With respect to the surveillance tools that we have, I don't have a DMO colleague sitting next to me here. So I just don't have a direct answer to the
Rick
the
Schultz,
question.
you want to come up to the table? Sorry, David, but you seem to call out for a lifeline.
Yeah,
you get two more lifelines.
Phone a friend. I was a phone a friend.
Yeah, I guess the short answer is no, we don't have that capability. To a large extent, it would involve looking at messaging data, which is something we're just starting to look at, and we would need more people that are familiar with algos, computer programmer types that would be able to look at that. So at this, that's something that we would be wanting to do down the road. But as I think as we mentioned at the last meet, as Commissioner O'Malley asked, we're now working to integrate our oversight of CEFs. We're also trying to integrate SDR data into our oversight of the swaps markets and the futures markets. So frankly, I don't see with our current resources that's something we'll have the capability to do in the near term.
Well, that and I don't know if Mr. Schultz, if you want to answer this one too, then, because my next question was about the prohibition on violating bids and offers operating as sort of the CEF world, and where there's no best execution requirement. How does this work in the CEF world?
Well,
and maybe back to you, David. I'm sorry, whoever.
That's right. I'll take it. The violation in you're talking about the first paragraph of the provision, which makes it a prohibited practice to violate bids or offers. That works in the CEF world only with respect to the order book. It doesn't work with respect to RFQs.
Okay. I do think it's significant that, what Mr. Schultz just said is that we don't have the tools to stop this stuff. So we can put the rule in place, or we can put your guidance in place, and it's concomitant with all the other of our rules. But bottom line is, we may not be able to catch these people until we go after them, and it could be a long time. So it's just another really shout out to Congress to say, you want us to abide by our rules, you want us to be able to enforce them, we need the technology tools and the people power to do so. Thank you.
Thank you, Commissioner Chilton. Commissioner Maya.
Bart actually said that he was intentionally going to front-run me on that question. Should be brought up on charges. So I do have a number of questions. David, I've sent you a list of 3 ATS strategies, which I think probably if I'll give to the reporter. I don't want to have to go through these, but you and I I've sent you the specific strategies.
The ones you sent me last night?
Yeah.
Yes.
Strobing, priority positioning or laddering, and front running. You've had the opportunity to review those. These are a variety of different strategies that involve, high level of cancellation, flashing liquidity, and then pulling it back real quick. Where does that fall in terms of our guidance?
Well,
maybe if you could kind of go by each strategy. If we try to explain it here, it might be a little difficult.
And David, as you think that through, I'm just asking unanimous consent to put those 3 things fully in the record.
I've got actually a pretty good little explanation on each one of them. So.
Right, so they'll all go fully in the record. Thanks.
What's going to go in the record is as sent to...
As sent to you,
okay.
The questions I sent
to you. Your first category concerned is labeled strobing. I can't tell you I've had a ton of opportunity to consider it, but it does, something that leaps out with respect to strobing, which is described in this document, is an HFT strategy that rapidly sends and cancels the same order many times to create the false appearance of liquidity. That one certainly seems like a problem to me under the provision. And I would be thinking about the third category of the provision, which concerns spoofing. Because I think what this is talking about is intentionally placing an order with an intent to cancel it before execution, which would meet the prohibitions.
So
language.
in this, they do flash orders. They just do it quickly, and if they are lifted, then that obviously the intent to cancel is, that intent seems to be mitigated if they actually did get lifted. So, this is a tough one to solve and obviously a tough one to describe in terms of what good and bad behavior is. So wouldn't the response be, well, we are placing orders? The question is, how fast do they get out?
Right. I think that's a very good question and good to clarify here. The offense is complete if someone places an order with the intent to cancel it at the time it's placed. It doesn't. I would suggest to you that it's not a defense if, in fact, that order is ultimately executed on. Just like, for example, in manipulation space, just by way of analogy, sometimes people will try to manipulate the market by putting in orders to move a market price. That's not spoofing. That's in the manipulation space. It's not a defense if, in fact, that order is executed on. That just so happens. Perhaps it's a cost of doing business. But so with respect to your question, I don't think that it's a valid defense to say, oh, the order was executed on. I should also point out that, just so the record's clear here, on your definition, not your definition, or this strobing hypothetical talks about an intent to create a false appearance of liquidity. That is not a necessarily element of spoofing. That's
good to know. Thank you. Do you want to address either priority positioning, laddering, or front running?
With respect to laddering, maybe I should just read what is laddering here.
Sure.
It says it's an HFT strategy for highly liquid markets, extracts profits from a market by using speed to gain superior positioning. This strategy adds very little or no benefit to or even harms the marketplace as it seeks to intercept trading that would otherwise take place and extract profits from the system without participating in the transference of risk. This one we would have to study further. This certainly suggests there may be a market structure issue and may well violate other provisions in the Act. But one question that would come to my mind is whether or not there was a disruptive, this was disruptive of orderly execution in the close. I don't see in the hypothetical, on the other hand, if you were trying to analyze this under spoofing, whether there was an intent to cancel. So it raises questions in my mind, but I wouldn't be able to answer those questions here on the spot.
Fair enough.
And then with respect to the last point, which is front running, and I'll just read that quickly. Front running defined here is an HFT strategy that relies on ultra-high speeds to observe a trade take place in the marketplace that they took no part in, so as to rush and buy or sell the underlying stock or future in front of the anticipated forthcoming hedge orders. As I read this to say that there's some strategy to watch trading take place and to sort of make observations about what trading is taking place, and then once you get that observation, you take advantage of the information that you've gathered. Again, for this one, I'd want to study this further. I don't see anything about on the spoofing side about intending to cancel orders, so that seems out. But with respect to does it, and I'll assume there's no violation of bids or offers, which is a per se offense. So again, it just raises a question about whether this is during the close and whether the trading conduct disrupts orderly execution.
Now, you brought up disruptive trading in the closing period, and since trades outside the closing period may affect the trading during the closing period, the portion of the rule effectively applies to all trading activities taking place on the registered entity's order book. Is that correct? Because we say anything, doesn't the guidance say that there is a closing period, and if you execute trades outside the closing period that affects the closing period, then that too would be considered affecting the close. Is that how you interpret it?
Yeah, it's conceivable that conduct that occurs outside of the closing period could disrupt the orderly execution. And the way the statute is written, it makes sense to consider conduct that occurs outside as possibly disruptive.
Would it possibly include trading that occurs in the open might affect the close? Is that how broad this is?
I wouldn't limit it. First of all, you keep on saying trading, and I keep on saying conduct. Conduct outside the close can disrupt the close. Could it be conduct during the opening? I mean, I guess it would depend upon the facts and circumstances. Obviously, as you get further and further away of a closing period on a particular day, it gets harder to prove that someone was acting recklessly with respect to the close. And we would certainly take that into consideration.
And this is one of your facts and circumstances kind of guidances.
That would certainly depend upon the facts and circumstances.
What about the practice of multiple trading strategies within a firm and kind of coming back to trade the S&P? If they were an equity strategy and a commodity strategy and they happen to cross in the S&P, same firm but different trading strategies, and they essentially cross themselves in the S&P, but executing different strategies on different markets. Do you believe that's disruptive?
And it would, I think you're talking about, again, about disrupting the orderly execution during the close. Well, I mean, just to be clear, there's the violation of bids or offers, there's disrupting the close, and then there's spoofing. There's no cancellation in your hypothetical.
Right.
And I'm assuming you're not worried about violating bids or offers. So you're talking about if there was disruption of a closing period because two different strategies on, from the same company hit themselves during the close, we would look at whether or not whether it was disorderly and whether the conduct was reckless.
Would it be under your new manipulation authorities a violation?
Under the new manipulation authorities, there is, that prohibits, again, all reckless conduct or reckless conduct, but there has to be some level of deception in the fraud-based manipulation space. So we would look to see whether or not there was some sort of deception of the market in that context.
Are there any other authorities that would be illegal?
Well, if a firm is meeting itself, it raises questions about whether there's a wash trade problem. One that comes to mind. I'd have to crack the book to look for others.
I should have put that in my written
question
submissions for you.
And frankly, what you say, when we look at facts, we sort of look at the facts carefully, and then we look to see whether or not there are any prohibitions that are violated.
As I said in my opening statement, I'm pleased that we have reserved some activities and have clarified that they are not captured into this disruptive. I think we have a long way to go in terms of really illuminating where this authority starts and stops. We attempted to do some of that here, obviously, but the market there's a lot of gray area in this one, and hopefully we'll continue to define the space a little better so everybody understands where good and bad behavior resides. So I appreciate your looking at those strategies and giving me your assessment. I look forward to following up with you on those. Thank you.
Thank you.
Thank you, Commissioner Malia. Commissioner Weejan.
I don't have any questions. Thanks.
All right. If there are no amendments, absent hearing any amendments, Ms. Juergens.
This is a vote on the Anti-Disruptive Practices Authority Interpretive Guidance and Policy Statement. Commissioner Weejan?
Aye.
Commissioner Weejan, aye. Commissioner O'Malia?
Aye.
Commissioner O'Malia, aye. Commissioner Chilton?
Aye.
Commissioner Chilton, aye. Commissioner Summers?
Aye.
Commissioner Summers, aye. Mr. Chairman?
Aye.
Mr. Chairman, aye. Mr. Chairman, on this question, the ayes have 5, the noes have 0.
The vote being unanimous with any technical corrections, Mr. Meister, if you can send this along with the Secretariat to the Federal Register. Before I ask for a motion to adjourn, I just want to again thank all of the staff. This is a very significant day for this commission and I think for the American public, that a market that is measured in vast numbers, nearly $20 of swaps for every dollar in our economy, took a step closer today to enhance transparency, both after the transaction and before the transaction. And I know a lot will be written about whether the request for quote motto was 2, 3, or 5, and it seems that that's caught a lot of public attention. I frankly think that's only part of the story and is a small part of the story. I think what we really did today is said there's swap execution facilities can come alive, compete with each other, provide transparency to the markets, that everybody in the marketplace is going to benefit and have an opportunity to come to these, that the block swap rule set appropriately, that approximately half of the market will benefit from greater post-trade transparency and later, after a transition, 2/3. I think these are very significant accomplishments for the American public and deliver on what Congress asked for. And I know all 5 commissioners have spent, feels like a lifetime on this particular set of rules. I really want to thank Commissioner Amalia, who first led the way in how to do a swap execution facility rule, because I know we spent a lot of time. I want to thank Commissioner Chilton, who, though he lost his stepdad just a week ago, has really participated, but also over these last 3.5 years, really looking out. And I think, Bart, you really brought many excellent suggestions to this rule. I know, as you said, wasn't exactly the rule you would have wanted. Commissioner Weechen, you and I have spent more time on this rule probably than any other rule, but I think we found the appropriate balance. I really do, and I know we both seem to be getting some press over this, but I really think this rule brings the appropriate transparency to the markets. And Commissioner Summers, though you didn't necessarily support the final rule, all of your suggestions were helpful. I think particularly on the international front, we made really good progress in making this rule more accessible internationally. And I'm going to miss you as a commissioner here. You have served the American public for, is it 7 years? Yeah, 6 years, since the day Bart was sworn in. And you've really served the public, and we all owe you a closing round of applause. Do you want to say anything before I take a motion to adjourn? No. Motion to adjourn the meeting?
So moved.
Second.
All in favor? Aye. Meeting's adjourned. Thank you.
de